This isn't really going to start hurting until the middle of the year.
Tariffs will be a net negative across the board. It's undoubtable.
This really can't be a surprise. The reality of the surprise is a little bit more painful for everybody to digest.
As things stand now, we're headed to recession. And it's very clear that this is a tax on businesses and households.
If the US is going to be in a waning economic environment, then it's most likely going to drag the rest of the world with it.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Let's get you to the weekend. Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Friday following major market moves. Equity markets extending losses, adding to the biggest one-day drop since the pandemic. Banks plunging, big tech taking a beating, and retailers absolutely decimated. President Trump's tariffs upending stocks worldwide and driving bond yields down to new lows for 2025 as we head into the payrolls report. Can the labour market hold up in the face of unprecedented policy volatility, and is Chair Powell in a position to step in? The Fed chair speaking later this morning, confronting upside risk to inflation and downside risk to growth.
And that's going to be the main event. As much as non-farm payrolls usually is the star moment of data for a week, not this week, because ultimately this is not going to tell us what is going to come. If Jay Powell takes the helm at 11:25 Eastern and repeats transitory, well, guess what? This market will feel a lot better. Right now, he's facing off with one-year inflation swaps in the United States at the highest levels since 2022 as Wall Street firms across the board downgrade their expectations for growth, and he has to send some kind of message.
For the S&P 500 as well, very quickly, the bear case is quickly becoming the base case. Lori Calvasina of RBC, new year-end price target, 55.50, down from 6,200. Our second cut so far this year, and she's not alone. And this line, our old bear case for the index this year has become our new base case.
It's pretty much across the board. You see this drumbeat of downgrades to the outlook. Not only Lori Calvasina, but Mark Halfley from UBS overnight coming out and reducing the December 2025 forecast to 5,800 from 6,400. A less pessimistic look. Look, the most interesting aspect about all of these downgrades is most of them are still expecting gains. They have not fully capitulated to this idea that we could see some sort of truly bear market continue. Is it predicated on the idea of a Fed put, which is getting baked into this market right now, or is it predicated on a policy shift in Washington, D.C.?
People don't believe the tariffs.
Correct.
Big step back. We've had a 5% move on the index in the last 24 hours. And when you go through all the research, speak to all the investors, the overwhelming consensus is this won't actually happen. What will happen if it does? April 5th is over the weekend. The reciprocal tariffs come in a week away. How long are they going to wait before they realize that maybe this is something they have to fully internalize?
And what does that look like in terms of downside risk? And I think that is the correct question to ask. What exactly are we pricing in? Is it just the uncertainty around these tariffs, or is it the actuality of a tariff rate unseen for 100 years? Hard to see that that's the case, but at what point are they going to believe it, given that maybe President Trump dropped a tea leaf, phenomenal deals he would accept? Define that. Go for it. Weekend reading.
Should we get to the price action?
Yeah.
High yield yesterday finally started to break. Big widening in spreads. 1, 2. The good news, and there was some good news, the bond market actually rallied. The bond market rallied because I'd be very afraid if I wake up one morning and we're all scared about policy in America, the dollar's weaker and treasuries are selling off, they're not being bought. That is the little silver lining that I can find in the price action of the last 24 hours.
It's not as if the rest of the world is pulling back en masse. If you take a look at the inflows for the past week, guess who did best? U.S. government bonds, which still suggests that they do have a haven property, or at least there is this feeling that even if the rest of the world is really ticked off at the United States, they're not going to boycott just yet U.S. treasuries. At what point is this the reason why the Trump put doesn't come into play for a while? He talked about how he wanted yields lower. He got them across the curve. And Jay Powell either has to confirm that or he has to potentially push against it.
Yields down to the front end of the curve for a 7th consecutive session. We are lower by 7 basis points. Your 2-year, 360. Your 10-year this morning, 394. Coming up this hour, John Stoltzfus of Oppenheimer on the latest sell-off. Rob Casey of Signum Global Advisors as Trump says he's open to negotiations. And Dan Ives of Wedbush on what tariffs mean for big tech. We begin this hour with stocks falling following their worst day since 2020, leading to more revisions across Wall Street and another downgrade from RBC's Lori Calvasina. Joining us now, John Stoltzfus of Oppenheimer, the biggest bull on Wall Street with a price target of 7,100. John, you know what the first question's going to be.
Oh,
north of 7K.
Course.
Is that going to change?
Well, without a doubt, where we're sitting here, it is under review, has been under review for a while. But the reality has been, until we got these rather surprising, unpleasant levels of tariffs that we got yesterday, and the market's reaction, we're naturally going to have to take a look at, sharpen our pencils, so to speak. I don't think we're going to be as drastic as some people have been at this point, but where we are, be something like a 29-30% upside, I think, to get to a 7,100 target off of the top of my head.
So, John, are you assuming the president blinks here? Is that the ultimate assumption?
I think ultimately, I think he does, and I think already you've got in the Senate, there's a bipartisan move to see how they can somehow check the president's capability on tariffs without congressional approval. I think that that looks like a possibility, you know. And the other thing is, the overreaction on a thing like this is not atypical. You know, immediately everybody figures that this is the way it's going to be. Yesterday looked like, you know, he's got to hold on to these tariffs and it's just going to be the end of the world. I think the key driver, I think, for him, I think in many ways, is when he looks at trade. That's his focus here, you know, and the level of the playing field, which is not exactly fair at this point. He figures if we're the biggest buyer in town, and the rest of the world is actually, with evidence particularly in China, but elsewhere around the world, suffering from overcapacity in manufacturing, which has been built over the last 40 years, not only in China, but throughout emerging markets and developed markets, usually with a destination of those products for the U.S., that there's a chance that others will come to the table. We've been of the opinion, John, that it's going to be cooler heads will prevail. But thus far, they haven't shown up at the dinner table.
John, what would it take for you to believe that these tariffs are real?
What would it take for me to believe? Well, I think if we saw these tariffs stick for any kind of a period that would last to several months, 2-3 months, I think that would be, you know, then you could figure this is it. In terms of are they real, I think that they most certainly are in terms of the way they're defined. Though there's always the exceptions to the rules. It looks like Latin America is almost being given a free hall pass. That looks curiously, you know, there are some things that are interesting when you look at this to think this is probably the first administration that has really dealt with this in years in terms of addressing trade, U.S. versus its partners, and what's fair in terms of tariffs and all that. But it's the way, you know, it's like the old song that goes, it's the way you do the things you do. The way you do the things you do has to do with creating volatility that may not have been necessary.
Well, hold on a second. I want to pick up on that, John. The way you do the things you do goes to execution risk and this idea that maybe the implied uncertainty for a prolonged period of time has a tax itself on equity valuations. How do you count that in a 7,100 target?
Yeah, well, that's why the target's under review. I mean, it's at this point, there's just, you know, when we put that target in, you've got to remember it was practically a different world. The markets were rejoicing on the outcome of the election. It was December 7th or 9th, as I recall, when we put it in. The 7,100 target implied a 17% upside. I think right now it would be a little bit over 30% from where we are, where we closed yesterday. The other thing is, you know, it's where we are today is likely not where we're going to be tomorrow, in that already the pressure is coming in, not only stateside, but from around the world, as to what does this mean? Are you really serious? You know, all that questioning in this. And I think that all that brings us closer to some kind of that moment when genuine negotiations start. But this was the first big shot across the bow, so to speak. It was, or more so, was throwing down the gauntlet. But it really, we were very much surprised that it was as dramatic and really, we thought a little bit overdone.
John, there's so many variables here, one of which is how others will respond. Big headline crossed on a Bloomberg terminal just seconds ago, so allow me to share it with you. China announces an extra 34% tariffs on US goods. That's the breaking news in the last couple of moments. Lisa, I think the date for this announcement, the date for it to take effect is important here, because next week on April 9th, the reciprocal tariffs kick in, and China's going with April 10th.
So how much is this trying to get leverage ahead of this? It's notable, an extra 34% tariff on U.S. goods. I want to see who calculated their number. I mean, how are we coming up with these numbers? Who is going to get hurt most by this? And initially it was the United States was going to be the epicenter. You take a look at the stock 600, tanking, taking another leg lower on this. So it raises the question of how much the rest of the world is going to get really caught up on the tit for tat that may or may not get resolved on April 9th.
Euro boom. What Euro boom? Euro stocks 50 entering correction. John, I want to come to you on this. It's almost impossible to understand all the different variables here, how others will respond, whether you can negotiate this, if they go on, how long they stay on, what companies will do, whether the consumer price tolerance is there. In the meantime, to Lisa's point, we're doing damage. Consumer sentiment has cratered. The soft data's ugly. The ISM Services Index yesterday didn't really get a look in because people were talking about tariffs. The employment component entered contractionary territory. And, John, I think that is really, really important going into this morning's payrolls report. Do you believe the hard data can hold up in the face of cratering sentiment?
Well, I think the cratering sentiment and the response really to the levels that where the market is now, if you consider that the market is 12% off of its peak right now on a year-to-date basis, it's a little over 8%, if I'm correct. I can't access my Bloomberg for some reason this morning. I had it earlier, but it just disappeared, so I can't check that number right away. Just off of the top of my head. But what I'd have to say is I think a lot of this has been overdone. The Bears have had a horrible 2-year period that just finished. They've got a great catalyst. It's called uncertainty. When we look at this from a historical perspective, gosh, we've been through the great financial crisis, COVID. Doesn't all this negative projection sound at all? It sound similar. It's in parallel because it's certainly on a very different thing. But, you know, usually it's times like these is where some of the best money is made, and it's not necessarily from short selling either. It's from catching babies that get tossed out with the bathwater. If you consider what the intermediate to longer trends are within technology, which is the worst hit area, and what it can do for all 11 of all the other all 11 sectors, including itself and communication services, in terms of creating greater efficiencies to navigate tough waters. You know, as you know, I've been around this business for 42 years. And my first rodeo was October 19th. 1987, when the Dow fell, I think it was 23% in a day. That's very different than from the beginning of this year to now. S&P 500 off 8%, and from its peak, its max drawdown at this point is 12%. We think this is, we have to put the drama in perspective and recognize, I think, that this is a workout period. And when these things happen, you generally find that cooler heads will prevail. I can't help but think of, what was it? Was it March or April of 2020? People were predicting all.
But John, as you know, in March and April of 2020, policymakers panicked. They did big things. And you know the old cliche on Wall Street, you can stop panicking when policymakers start to. I don't see any sign of that, do you?
But the wonderful thing was that, as I recall, that was a recession that looked so short that the arbiter of when recessions start and begin didn't even call it a recession. The decline was, I think it was over the course of a month. It was significant decline, as I recall. It was a bear market decline. And then it just popped back because enough liquidity was provided that helped us through that. In this case, it's a question of really bringing down the rhetoric and raising the process, the quality of negotiation. Because a few weeks ago, we said that we were surprised that the European markets were doing as well as they were, because we just look at it and we think it's a question of the biggest buyer is the U.S., and it's a tough one to replace. You can say we'll go to the emerging markets and replace it, but the problem is the emerging markets don't have the same buying power. They don't have the same middle class. China can outbuy anybody in terms of Ferraris, okay?
Yeah.
It can outbuy anybody in terms of Birkin bags and Louis Vuitton bags, what have you. But when it comes to, the basic commoditized stuff, whether it's pen and pencil sets or, I don't know, probably what this hotel room is furnished with, the U.S. is the one that can write the check.
John, do me a favour. When this equity review is complete, come back on a programme and we'll talk again next week. John Stoltzfus there of Oppenheimer on the latest equity market. I want to get back to this breaking news. The latest from China, announcing an extra 34% tariffs on U.S. goods. That will hit next week, the day after the reciprocal tariffs from America are set to kick in. The reaction in Europe. Can we turn to European equity markets? Lisa, check this out. The DAX down by more than 3%. Over in Italy, we're down by close to 6% on the FTSE MIB.
They're going to get caught up in this potentially as much, if not more, than the United States. And that is the shift between yesterday and today. Yesterday, the pain was concentrated in U.S. assets. Today, the focus is it true that when the U.S. sneezes, the rest of the world catches a cold? I do want to just give you this. The Chinese ministry, this is what they said. This is a typical act of unilateral bullying, urging Washington to, quote, immediately remove the tariffs and resolve any disputes through, quote, fair and equal dialogue with its trade partners. How much is them trying to get an upper hand in negotiations ahead of April 9th?
Let's see if they can negotiate it. The overwhelming consensus right now, waking up on a Friday morning on Wall Street, is that this still doesn't happen. This takes long weeks and long months to internalize. And maybe then it's too late.
If you took a look at the talking points that the administration put out to its people yesterday, they included there was no room for negotiation. Take that as you will. But they're not coming out saying, let's get a deal done. They're coming out saying this has been structurally unfair for a very long time and we need to change it.
Equity futures right now, session lows on the S&P. We're down another 1.6%. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg brief. China announcing 34% reciprocal tariffs on the United States. The Customs Tariff Commission saying the additional tariffs are set to take effect on April 10th. Elsewhere, President Donald Trump saying he's open to tariff cuts in return for, quote, phenomenal offers. Trump adding that his plan gives the U.S. great power to negotiate, and there are more tariffs on the way, including on pharma and on chips. And finally, Republicans debating raising the top tax rate to 40% for those earning $1 million or more. According to people familiar with the matter, officials are beginning to draft a package with the hopes of passing it within the coming months. That right there is your Bloomberg brief. Up next on the program, the president open to offers.
Every country's called us. That's the beauty of what we do.
Are you open to deals with these countries if they're calling you?
Well, it depends. If somebody said that we're going to give you something that's so phenomenal.
Up next on the program, Rob Casey of Signum, Global Advisors, live from New York City this morning. Good morning. Session lows on the S&P. We're down by 1.7% on the S&P 500. On the Nasdaq, we're down by another 1.8. Under surveillance this morning, the president open to offers.
It was a sick patient that went through an operation on Liberation Day, and it's going to be a booming country. Every country's called us. That's the beauty of what we do. We put ourselves in the driver's seat.
Are you open to deals with these countries if they're calling you?
Well, it depends. If somebody said that we're going to give you something that's so phenomenal, as long as they're giving us something that's good.
Here's the latest this morning. President Trump saying tariffs give the U.S. power to negotiate. The president reiterating his willingness to offer tariff relief for China if Beijing approves the sale of U.S. TikTok operations. Bloomberg's Wendy Benjaminson joins us now for more. Wendy, welcome to the program. China's got an offer. It's a 34% tariff. This tit for tat. How much worse is that going to get?
Who knows? But if that is any indication of how it's going to go, we know France and Germany are considering retaliation. Japan is holding its fire. We're just going to have to see how this all shakes out. But that clip of Donald Trump on the plane saying, he was open to negotiations. This is classic Donald Trump. He throws these extreme proposals out there, these extreme policies, and then uses that as leverage to get what he wants on other things. Like, how are tariffs related to the sale of TikTok, which was legislation passed in the Biden administration to force the sale? So he's conflating all of these things to manipulate other countries to do what he wants.
Are they going to come to the table, Lisa? That's the question that I'd be asking this morning. We spoke to the Commerce Secretary yesterday, and I said, maybe you don't have the leverage you think you have. The Chinese aren't coming to the table. You see no sign of that. Where's the call between Xi and Trump? That's not on the cards at all.
This is the key question, and the reason why potentially you're seeing Europe do really badly on the heels of this. You could say, first of all, they're caught in the wake of this. But second of all, how do they come to the table with something phenomenal at a time when they've got a lot of disagreement with their union members? And with China, they have a lot more leverage when they're trying to make their economy more domestic. So it is a huge gamble. There's huge execution risk. At the same time, a lot of people are trying to say, there is something structurally unfair, and maybe this goes to resolve it.
Rob Casey of Signum Global Advisors joins us around the table. Rob, good morning.
Morning.
What on earth did you tell clients yesterday?
Well, I think we told clients, first of all, that this was bigger than we expected, right? And I think it was essentially bigger than everybody expected. We also told clients that we think 10% sticks on April 5th. We are skeptical that we see the April 9th reciprocal tariffs laid out as President Donald Trump announced on Wednesday, and as Commerce Secretary Lutnick, among others, keep telling us, or told us over the course of yesterday. We think instead negotiated, punted, maybe shied away from.
John and Annmarie were trying to get to this with Howard Lutnick yesterday about where this number came from, where the formula came from. He kind of didn't give a full response, but a lot of people keep wondering, what is this formula that we're working with, and who is in the driver's seat? Do you have a sense?
Well, in terms of the driver's seat, I think you have to look at two people, Jameson Greer and Howard Lutnick. I think it's pretty clear to me that Bessent is potentially a little bit of a deer in headlights at this moment, right? He said for weeks, if not months, that this would not be as bad as Wednesday was. Over the course of the campaign, he really seemed to be the calming presence, right? I mean, he was auditioning for the job at that point. He wasn't in the seat yet. But I think at this point, it's Greer, it's Lutnick, and I also think we have to remind ourselves that the person making these decisions, as he said time and time again, is President Trump. So it's not sort of a Wizard of Oz behind the curtain. I think on Wednesday, Donald Trump woke up and was presented with some options, and this is the menu item that he chose.
There's a real question here about how open he is to doing deals. He said phenomenal offers. Unclear how many phenomenal offers are coming out. 34% tariffs by China. Maybe that's a phenomenal offer in a different kind of way. How much are the people who you talk to counting on some sort of deal coming to pass?
Well, I still think it's probably a sort of a latent consensus that we do get some sort of negotiations, and that April 5th and April 9th don't go
Rob,
off.
can I jump in? Why do you believe that? Where does that come from? Is it just the mutually assured destruction that this economy just craters? Where does that faith come from?
Well, I mean, so far over the course of President Trump's second term, he's made 20, really serious tariff threats, right? He's only laid on 4 of those, twice on China, on steel and aluminum, and on autos, right? Everything else he's rolled back. And in particular, he continues to roll back threats against Canada and Mexico. One could say that that's because Canada and Mexico are following through on the promises that they've made. But I think, honestly, it's because that the markets, they puke when they hear about tariffs on USMCA countries, our biggest trading partners. Markets did not really puke when we got the first 10% on China. They didn't really puke when we got the second 10% on China. So those have stayed, right? But I still think that there's sort of a push and pull as to what President Trump wants to do and what he feels able to do post hoc.
Well, markets are certainly puking now. And I think that's the ultimate position we need to stress test throughout this morning. Where does that faith come from? And will it stand up to the pressure of the next few weeks?
And does President Trump care if the markets puke this time around? If the bond market isn't puking, it's doing quite the opposite. And that is a real test at a time when a lot of people are saying, OK, let's try this out. OK, what does this do? It loses about a quarter of a value of most of your major retailers in the United States. Yesterday, Trump also said that he was potentially going to add additional tariffs.
Rob Casey of Signum Global Advisors. Rob, good to see you. Lisa mentioned the bond market. We're down 15 basis points at the front end of the curve. Up next, we'll talk big tech. Dan Ives of Wedbush from New York City. This is Bloomberg. We're not going quietly into the weekend. Equity futures right now down by 2.6% on the S&P. Session lows, we're down 3% on the Nasdaq 100, following the biggest one-day drop since June 2020, and no bounce. Let's get you some movers. Apple, down 9% yesterday. Apple this morning, down 4.6%. This came from Rosenblatt. It's hard for us to imagine Trump blowing up an American icon. That suggests something is likely to give. That is the belief on Wall Street right now, that something will give. Nike down double digits yesterday, down 2.8 this morning. The April 2nd tariffs seem purpose-built to hobble the apparel industry. William Blair, again, people believe this is so bad it just won't happen. JPMorgan, the worst day since the pandemic. So outside of the regional bank crisis, this is the worst day since the pandemic yesterday for JPMorgan, down this morning by 5.7%. They deliver earnings, Lisa, this time next week.
How do they give guidance?
How on earth do they do that?
I don't see how they can. And what I find interesting is, especially with what you just highlighted, it's across the board. This isn't one sector. You saw this with Lululemon, Nike, Abercrombie and Fitch, Gap, yes. But you also saw it with the likes of Norwegian Cruise, that they were down more than 10%. With respect to Carvana, with respect to KKR, with respect to Ares and Evercore, JPMorgan, this is all coming at a time where every industry is going to get hit, at a time when people don't believe that this actually could go through. So it raises the question, how much is just the uncertainty premium and how much is an actual belief that these tariffs are real?
We've talked a lot about upside risk to inflation and downside risk to growth. The towel was in the commodity market yesterday. The focus was on downside risk to growth. Crude cratered. And the bond market, check out the bond market now. 2-year, 10-year, 30-year, yields down double digits across the curve. We're down 16, 17 basis points on a 2-year to 351.65 on 10s. 388.79. We're 2 hours away from the payrolls report and we've hardly talked about it. On our radar this morning, President Donald Trump saying he's open to cutting tariff in return for, quote, phenomenal offers. Trump adding that more tariffs are on the way, including on pharma and on chips. And China's got more to say, because from their side, more tariffs are also on the way.
34% that would go into place, and this is important, on April 10th, ostensibly, and this comes the day after. There is this deadline for the U.S. tariffs to go on. Does this leave room for negotiation? Interestingly, there are 11 companies that China is targeting from the United States that they're calling unreliable in this offer, at the same time that they're potentially going to have certain controls on certain precious metals. They have leverage too, and that is basically the message that they are trying to send.
We said this repeatedly over the last few months, that the strategic anchor for equity market bulls is the complete policy mix. You've got to include the tax package. Here's the latest on that tax package. Republicans weighing the creation of a new tax bracket for millionaires. Sources telling us here at Bloomberg, deliberations have included a new top rate that would be around 40%.
This would be in excess of what was the case under President Obama, and it would rise from, I believe, around 36%. What this highlights to me is the difficulty in trying to get a tax package through a Republican House and Senate that is concerned about the fiscal deficit, that is concerned about some sort of retrenchment of the overhang of debt. And how do you do that at a time when you potentially need to expand the balance sheet in other capacities? This would be the first time in decades that Republicans would propose a tax hike.
They need to change the conversation. And the conversation needs to get to taxes and not to hikes, but to cuts. And that's a very different conversation. This one is too. President Donald Trump saying the United States is close to reaching a TikTok deal involving multiple investors. Trump also reiterating that he would be willing to offer tariff relief in exchange for China's help in approving an eventual TikTok sale.
Put this into April 9th with potentially 54% effective rates on China by the U.S. and then the retaliatory tariffs coming into place by China the next day. It is kind of a mush. Meanwhile, when you take a look at the details of this, it's also highly complicated, talking about what ByteDance gets to actually keep, how much the algorithm gets outsourced and managed by other people, and the consortium of investors that are going to be potentially involved.
Who are they negotiating with?
Exactly.
That's the number one question. Who are they talking to? You have a deal today. OK, great. Go into the weekend. We all celebrate it. Maybe we can have another Rose Garden address. I don't know. Deal's done. Who have they negotiated with in China? Who signed off on this? The Chinese have just turned around and said, we're going to put 34% tariffs on you next week. There's no sign they're coming to the table to talk about anything. Never mind TikTok.
We have no sense of what the leverage is on either side. And we don't have a sense of exactly what the willingness is. We've heard from China that they're not willing, and we've heard them come out about the Panama Canal and actually push back against the sale that we saw with BlackRock, saying, you didn't tell us before doing this. So it's unclear exactly how willing China is to play by rules set out by the United States.
If you are just joining us, welcome to the programme. So equities lower again. We're down by 2.3% on the S&P 500 following yesterday's losses. As you know, big tech felt the brunt of the equity market sell-off with over $1.4 trillion in market cap wiped out from the Nasdaq 100. Dan Ives of Wedbush writing the economic pain that will be brought by these tariffs are hard to describe and can essentially take the US tech industry back a decade in the process while China steams ahead. Dan joins us now for more. Dan, good morning.
Great to be here.
You're an analyst. What do you do?
I mean, look, 25 years covering tech and markets. It's probably the most absurd 36 hours that I've ever seen, because my view is that this is an economic Armageddon if these tariffs come through. And I think from a tech perspective, in terms of probably like one of the biggest assets we have in this country, it would take us back potentially a decade, and it would steamroll China ahead. And that's why our whole point right here, even if you got a deal in a month or two, you're already looking at 5 to 10% earnings cuts across the board in tech just to start. And I think that's really the worry right now as a tech investor.
Apple, American icon. And for that reason, nobody believes this is going to happen. They're looking for exemptions. They report in a month at the very start of May. How do they offer any guidance at all?
Oh, I mean, we've said we don't believe Apple, or actually basically any other tech company, gives guidance, because you're essentially blindfolded playing darts, giving guidance. And it comes down to, like, if you wanted to implode Apple and you wanted to actually try to figure out the formula to actually make this company what I really view, it could take them back years. It's this tariff, because it comes down to a 54% from China. It would take 3 years and $20 billion to take even 10% of the supply chain to the U.S. If you want $3,500 iPhones, we should build them in New Jersey. We should build them in Texas. If you like $1,000 iPhones, you build them in China. And I think that fundamentally is really the issue here in terms of the near-term pain would be 5, 7, 8. It would change Apple as a company.
Which is the reason why a lot of people don't believe that this is actually going to come through. Even if there is some kind of negotiation, how much damage do you think is being done just simply through the uncertainty?
You're burning the house down, but then you still have a toaster oven and the bagels ready. The point is, like, the damage that's being done here. I mean, I've talked to so many tech executives over the last 48 hours, and they don't know. And the worry is the uncertainty, the inventory. What does this mean? You talk about, all the conversations we've had over the years, AI revolution, in my opinion, fourth industrial revolution, where we are in tech, overall markets. And this essentially, it's imploding it, self-inflicted. And I think that's really the befuddling thing for investors in terms of where we sit here and what the next steps are.
Yesterday, the Magnificent Seven lost more than $1 trillion in market valuation. That's the first time that's ever happened in one day for these stocks, down 24% from the December peak. Do you think that there is potentially, as a perennial bull in the U.S. tech sector, do you think there's actually more downside ahead simply because this uncertainty isn't going to go away?
I mean, look, this uncertainty in itself, it's already taken numbers down. And then it becomes a self-fulfilling prophecy. Now, in terms of the long term, Mag 7, our view of tech, of course, that continues to be very bullish over the long term. But right now, I mean, we are sitting on the precipice of an economic Armageddon. It doesn't matter what you say in the Beltway, in front of microphones, and the reality is talk to executives, see what's actually happening. And I think that right now is what tech stocks are reflecting. Investors, they're not Republican or Democrat. They're speaking in terms of what stocks are telling you. And we are in the midst of like just a massive, what I believe is an economic Armageddon if this continues.
So Dan, Apple, you've got an outperform. Tesla, you've got an outperform. Microsoft, you've got an outperform. You also cover GM, you've got an outperform. When are you going to revise these calls?
Look, it comes down to like if the tariffs stick and they continue for the weeks, months ahead, then we have to change our whole outlook.
Can you help me understand that just a little bit more?
Yeah.
So these are the dates.
Sure.
So April 5th, tomorrow, baseline tariffs, 10% kick in. April 9th, next week, the additional tariffs kick in. How long do you wait?
So let's walk through, and this is what I've been telling investors around the globe the last 48 hours. Okay, 2Q is going to be a disaster, and it's already factored.
So that's a write-off.
So that's 2Q is already like blindfolded darts what it's going to be. 3Q. So you basically have to look and be like, okay, the next 3 to 6 months, I wouldn't call them a wash, but basically the street's going to look through, okay, what do numbers look like, run rate, if these tariffs get to some sort of baseline, Q4 2026. So you basically go back to the playbook that we've used in COVID in those early days, March, June, in terms of COVID playbooks, looking out, normalize, assuming that this in some way gets negotiated. But it comes down to, if these tariffs stay, all bets off, because it changes the whole paradigm.
Do you expect, though, to see that kind of upside, the outperformance, anytime in the near future? Or are you basically saying that at this point, you're not getting that kind of capitulation? So if you have faith over the next 10 years, fabulous, you might get a good entry point. But otherwise, not really worth getting in.
Look, in the near term, a lot of it, unfortunately, it's based on what we see with negotiations. If they happen, what happens with China? TikTok, is that one of the first chips on the table? The reality is that the growth story, in terms of where we see tech over the next, call it 9, 12, 18, 24, that doesn't change here. But the reality is that if this continues, the longer it stays, once the snowball starts going downhill, you can't stop it.
Elon Musk, I want to just talk to you a little bit about Tesla and what we've seen over the past few weeks. We have heard from President Trump yesterday that he expects and he would like Elon Musk to stay on with the Doge effort for a prolonged period of time, but that he will be going back to his company maybe in a period of months. Does that help insulate Tesla, or is Tesla uniquely vulnerable because of Elon Musk's relationship with this administration?
Every day Musk stays at Doge and the government, it's another day that there's more brand destruction for Tesla. And that's just a reality. Tesla's become a political symbol. So what we've talked about is that Musk, in our view, really has no choice. He has to take a step back to CEO of Tesla. Because look at the 1Q delivery numbers. Look at, just even if you look from brand issues, that crisis continues. I think the long-term sort of view and the long-term brand of Tesla changes, and that continues to be, how we view it. It's a fork in the road. It's a moment of truth for Musk. He needs to make the right decision as a fiduciary and CEO of Tesla.
Got another cut to estimates this morning, this time from JPMorgan on Tesla. First quarter vehicle sales were far below even their estimates and, quote, confirmed the unprecedented brand damage we had earlier feared.
And we saw these anecdotes about European sales. We saw anecdotes about Canada. This is coming to pass at a time when he is expected to go back, but it's unclear whether that can really revive a brand, especially at a time of increasing competition from China. And that, I think, is Dan Ives' other point that I think is really
Dan, just before you go on China and TikTok, I saw you smiling as Lisa and I were talking about the potential deal. Who are they negotiating with?
Themselves. Look, it just comes down to okay, is it Oracle, Ellison, PE? Look, my whole view there is that it's a chip on the table. ByteDance keeps the algorithm. There's some sort of combination, in terms of who ultimately sells it. But I just view it as part of a broader negotiation. But again, if I'm negotiating with myself in my room, what does that do? It comes down to what does Beijing say?
Dan, it's good to see you, sir.
Thank you.
It's great to catch up. If you are just joining us, welcome to the programme. Equities down across the board, extending losses this morning and very close to session lows. We're down 2.5% on the S&P 500. About 40 minutes ago, we had a headline out of China that they announced an extra 34% tariffs on US goods. Those tariffs are set to kick in the day after the reciprocal tariffs from the US kick in on April 9th. So that's how the stage is set right now going into next week for what many people think will be a round of negotiations. Will we actually see it take place?
And will we see what Scott Bessent was saying? Just take a deep breath. Don't retaliate. Just step back, let it happen, absorb it, take it in. Well, they've taken it in, and we've gotten some response, and it's a little bit less passive.
I have tremendous respect for the Treasury Secretary and his experience on Wall Street. You know that. Everyone knows that. I got the sense when he spoke to Annmarie this week that he was not in the room for these conversations. And I think a lot of other people got that sense too from watching that exchange with Annmarie. I imagine that unnerved people as well, because they thought they were the safe hands. A lot of people thought they were the safe hands in this administration. And when you get the impression that the safe hands aren't part of the conversation, that's going to rattle nerves.
To be just more specific, the reason why people got that impression was because when Annmarie asked him about Mexico, about Canada, and why they were not included, he did not know. When she asked about how much room there was for negotiation, he did not know. That was up to President Trump. It felt like he was maybe not in that space making those decisions.
Equities right now down by 2.5%. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg brief. Vice President J.D. Vance downplaying the global rout in stocks driven by President Trump's tariffs. Vance describing yesterday's massive sell-off as one bad day in the stock market and promising a booming market ahead. JPMorgan's top economists raising recession odds to 60% after the Trump administration announced its once-a-century tariffs. Bruce Kasman calling the tariffs the largest tax hike on U.S. households and businesses since 1968. The title of his report yesterday, Bloodbath. Intel and TSMC have reached a prelim agreement to form a joint venture to operate Intel's chip-making facilities. The information reporting the Trump administration reportedly initiated the talks between the two giants in an effort to revitalize the company. From New York City, that right there is your Bloomberg brief. And up next, the weight of uncertainty.
Uncertainty, as far as I'm concerned, is the killer of everything. This uncertainty, to me, just is going to weigh on that consumer sentiment. We've already seen it so far this year.
Later on this morning, 8:30 Eastern Time, payroll's just around the corner. Reaction and a preview from Sarah House of Wells Fargo from New York. This is Bloomberg. Yesterday, the biggest one-day drop since the pandemic. This morning, no bounce. We're lower again. Session lows rolling over, negative by 2.6%. On the Nasdaq, we're down by 2.75. On a Russell, we're negative another 4 percentage points. Under surveillance this morning, the weight of uncertainty.
Uncertainty, as far as I'm concerned, is the killer of everything. You know, if you're a corporate, if you're a boardroom, uncertainty stops you from making those investment decisions. It stops you from making those hiring decisions. This uncertainty, to me, just is going to weigh on that consumer sentiment. We've already seen it so far this year.
So here's the latest this morning. Retailers taking a massive hit as a President Donald Trump tariff agenda puts increasing pressure on the U.S. consumer. Sarah House of Wells Fargo writing, March will mark the second month in which additional tariffs on all Chinese goods were in effect, making it an early tell on how quickly higher import duties could feed through to consumer prices. Sarah joins us now for more. Sarah, welcome. Until this conversation, we haven't talked about the payrolls report at all. Haven't spent a minute on it. Sarah, how relevant is that report at 8:30 Eastern Time?
It's certainly less relevant than it usually is, just given all the news that we've had since that March survey week. But I still think it's important in terms of level setting where we are heading into these additional headwinds for the economy, and also getting a glimpse of what perhaps some of the damage from some of the DOGE efforts, federal spending cuts are taking on the labor market, in addition to some of this trade and tariff policy headwinds that we've been focused so much on over the past week or so.
Heading into that yesterday, and I wanted to pick out this point, John referenced it earlier, we did get ISM services, and it highlighted that the labor component of that index was the weakest going back to December 2023. Are there signs that maybe it won't show up in this report, but that this truly will be the last good payrolls report, and that there is this sort of deterioration behind it?
Yeah, I think that's certainly the risk of what we're looking at today. So we think there's still some helpful factors for today's print. So expecting a rebound in leisure and hospitality hiring after that was down the past couple months, just as the spring weather normalized versus a chilly winter. You've got a couple strikes ending. That's going to lift the payrolls by about 15,000. But when we look ahead at some of the PMI's data, so not just the ISM services that we saw yesterday, but the regional Fed surveys are saying the same thing. You've seen Indeed job postings come down. And so there's really a lot of indications that businesses' appetite to hire has really withered over the past month or so. And as we move forward, just as soon as April, you could be seeing, comfortably below 100,000 jobs prints, maybe even flirting with some negative prints. So I think you're right. This is going to potentially be the last decent jobs report that we could see for a while.
There's been this theory that a lot of employers haven't been laying people off. They've been reluctant to do so and are pulling all other levers to avoid so, just simply because of their experience during the pandemic. Do you still think that dynamic is in play, really supporting this labor market?
I think that's true to an extent, but the issue is we've seen that hiring rate come down so much that there's less and less scope to manage headcount through things like attrition than what we were looking at a year or two ago. And so now with an additional growth slowdown in the works, that's really going to put pressure on the headcount numbers, and in some ways leaves layoffs as the only remaining option. And while businesses might be even more reluctant to let workers go than maybe they have in prior cycles, just knowing how hard fought that was, when push comes to shove and they're looking at their costs, sometimes that is the only option. So I think we're getting closer to that risk of layoffs, just as we don't have as much cushion as maybe we did a year or two ago, when those low layoffs have really helped keep those net hiring numbers in good shape.
Sarah, somewhere this morning there's a laptop open with a draft of Chairman Powell's speech on it. And I wonder how much it needs to be edited after the last 24 hours. What on earth does the Fed chair say when we hear from him at 11:25?
Yeah, so I think it'll be interesting where you've seen a lot of the Fed speak in recent week has maybe pushed back a little bit against some of that transitory nature of the tariff shock, underscoring that, yes, that's the textbook. That's what happens in textbooks. But in reality, it can take time to see that implementation. We all know transitory could end up being a lot longer than what it maybe initially implies. So I think I'll be listening for, is he maybe walking that back and showing more concern about inflation, or does he think that the risks still are maybe balanced, particularly depending on what we see out of today's jobs number, and if that does show some further loss of momentum like we expect.
Hey, Sarah, appreciate the update. Sarah House there of Wells Fargo on the latest. Let's unpack those 2 points. So number one, on the payrolls report, it could be the last good one. For that reason, a lot of people might just look through strength. Second point, Chairman Powell. That means he's got to be the main event today, right? Chairman Powell, 11:25.
100%. People are not looking at necessarily getting some sort of confirmation or information that's forward-looking from this particular payrolls report. It's more getting a sense of where we're coming from. Jay Powell has to either push back against market pricing, which is now pricing 100% chance of 4 or more cuts for the remainder of this year. That is how much is being priced into Fed funds futures. He has to either push back against that or enforce that at a time where you also see climbing inflation expectations. Why is he speaking? I think that's my ultimate question. If he has nothing to say, why is he giving a speech today?
They're in a bind, aren't they?
Yes.
I really don't understand what the chairman should do at this point. At the moment, he's looking at a policy down in Washington, D.C. that could change a week later, 2 weeks later, and he's looking at hard data that so far has held up pretty well in the face of cratering sentiment. So as far as they're concerned, they're not going to act until they see it in the hard data, which means they're not going to act until maybe it's too late.
That's what a lot of people have been arguing, and yet we heard from Bob Michael of JPMorgan yesterday. He expects the Fed to move on this and to front run it, and that's what a lot of people are expecting, just to add another wrinkle to this. And the reason why I ask why is he speaking is because there's a political overlay. There is an administration that wants to see lower yields, would like him to respond to potential weakness in the economy. And so if you put yourself out there saying, I will not cut, well, then you make yourself a poster child of it. If you come out there and say the market is correct, we will respond to weakness and we will look through inflation, you really raise the prospect of continuing some of the strength that can prolong the inflation. It's damned if they do, damned if they don't, so good luck.
The S&P 500 down by 3% in the bond market. Bond yields are lower at the front end of the curve now by 17 basis points. 350 on a 2-year. Yields down for a 7th consecutive session. Up next on the programme, Priya Misra of JPMorgan, Michael Zezas of Morgan Stanley, Aditya Bhave of Bank of America, and the former Boston Fed President, Eric Rosengren from New York City, the second hour of Bloomberg Surveillance. Up next.
Globalization is not going to be like we have seen it in the past.
Every company is going to absorb these impacts very differently, and you're not going to see it immediately in job loss.
The U.S. market is a big market. It's kind of hard to get out of it completely.
If China starts to make friends with our allies around a shared dislike of Trump, this is a bigger concern.
We'll see some of these backed off. I don't think the administration wants to crash the economy.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The second hour of Bloomberg Surveillance starts right now, 90 minutes away from the payrolls report and your scores look like this Friday morning. Good morning to you all. Lower by 2.7% on the S&P 500. On the Nasdaq, down by 2.9. On the Russell, down by 4 full percentage points. Should we focus on upside risk to inflation or downside risk to growth? There's a clue in the bond market. The 2-year yield is lower by 15 basis points to 3.53. We're down 12 on 10s to 3.90. As we anticipate the payrolls report later this morning, the estimate 140K. Sarah House of Wells Fargo with us 10 minutes ago saying this could be the last good one. That drops at 8:30 Eastern time. Then after that, Chairman Powell going into the weekend. Who blinks first? We'll hear from the chairman, Lisa, at 11:25 Eastern time.
Does he lean into the weakness that right now this market is picking up on? And certainly bond markets are expecting a Federal Reserve that will respond more to weakness than, say, some sort of pop in near-term inflation. He said the T word, it's out of the bottle. Let's see if he doubles down on transitory and talks about looking through the effects of tariffs. But ultimately, what can he say at a time when we're not getting the hard data, where policy is still uncertain, and frankly, they have a lot to lose on both sides here.
We've all read the same research. Research note after research note. It's really bad. Bruce Kassman at JPMorgan, bloodbath. That was the headline. Bruce isn't the kind of guy that writes a headline that says bloodbath.
No.
He thinks the odds of recession now is 60%. But if you read the note, it still isn't in their forecasts. And I saw that repeatedly yesterday. A lot of people do not think that even if these tariffs go on the 5th, go on again on the 9th, even if China responds on the 10th, people don't think they'll stick. How long before we have to completely internalize the potential that maybe they will? And that's what's interesting about the price action from yesterday. So you can have a 4-5 percentage point move on the index in America. That's not even baking in the tariffs that were announced the day before. It's just a very real risk that it might happen.
To rip up the script, I was talking with a couple of money managers yesterday, and it struck me that a lot of people on Wall Street are conditioned to be calm, conditioned to see volatility as an opportunity, conditioned to look for what you can buy amid the chaos. And that still is the position that a lot of people are in after years of outperformance of U.S. equities. They still will outperform. And there is this feeling this too will be worked out because it always has been before, which is the reason why people are looking at the off-ramps. There is the Fed off-ramp, there is the Trump off-ramp, but either way, there will be some sort of off-ramp. The tail risks are getting fatter. And in a survey of economists by Bloomberg, it showed that recession odds have increased by 92%, but the odds of trade agreements have increased by almost 60%. So both sides coming to the fore with faith.
When you see big shifts like this, huge shifts that could lead to major regime change, it takes weeks, months, quarters, years to fully internalize how powerful that change might be, what things might actually look like. And the issue that I have with a lot of people on the sell side right now who haven't cut their price targets is they can sit here and say the tariffs might not be on in 2, 3, 4 months' time, but maybe the stock is down another 10, 15, 20 basis points, 20 percentage points in that time. And by then, who have you helped? Who does that help? That helps nobody.
At the same time, how do you help anybody right now when you can't give guidance? And this is part of the issue, is that things are moving so fast that when you talk to people, there is a bit of a deer in headlights feel for everybody because there isn't a sense of what formula you can use. I will just say this. How do you even get a sense of what the uncertainty tax is and strip that out versus the implementation of some of these tariffs? And then you can come out with some timelines for at what point you've got to price in tariffs and at what point you're just pricing in the uncertainty itself.
Copper down 4% this morning. Crude down another 6% on Brent. WTI down another 6.8. Keeps answering the same question. This focus for this market is on growth and not inflation.
Which to me is the ultimate question. How much do you see a uniform downgrading of growth expectations around the world? And it's not just the United States. We did see that from Wall Street firms across the board. At the same time that there's an upside shift in inflation on oil. Interesting that OPEC Plus is increasing production. And how much is this a tea leaf to President Trump? And how much is this basically saying to all of those who are overproducing, all right, game on, let's go.
That was certainly an objective to get crude down. I'm not sure if this was by design, but the objective's being met. Neil Dutta summed it up well, didn't he, in the last 24 hours? Obliteration day. It continues for a second session. Coming up on the programme, Priya Misra of JPMorgan as Trump's tariffs roil markets for a second straight day. Michael Zezas of Morgan Stanley as the president looks for phenomenal offers from trading partners. And the former Boston Fed president Eric Rosengren as traders boost bets for Fed rate cuts. We begin this hour with stocks falling for a second straight day. Priya Misra of JPMorgan saying the risk of a recession is about 50% and the market is not priced for a 50% recession. She goes on to say, where is the policy put? not at these levels. There's no sense of panic in the White House or the Fed. Priya joins us now for more. Priya, good morning.
Morning.
You sum it up perfectly. We can stop panicking when policymakers start panicking. You see any sign of that right now?
I don't. I think there is a hope trade, though, in the market. I think the hope is that this is the start of negotiation, and that this is actually not going to stick. And maybe that's right, but if the uncertainty, I love your uncertainty tax. That's what we're all grappling with. The Fed is grappling with that as well. And so as that hope evaporates and that uncertainty stays, so I don't buy, maybe there are negotiations, but that uncertainty has to build before you actually get that deal. The other big hope is fiscal. There's this hope that we're going to get this fiscal stimulus and everything's going to be fine. Well, the politics are not there yet. Now, do we actually get those tax cuts? We're talking about extension. Where's the additional stimulus? So as this hope trade, and I don't want to sound alarmist, but we've had massive shift and this is an ideological White House. I think when we came into this year, there was the ideological side, there was the pragmatic side, and we haven't really seen that pragmatic side. And I think, I don't know, is there an economic put? If we go into a recession, do cooler heads prevail? Perhaps. We're not there yet. The hard data has been strong. I don't know if today will give you that sense, but you need those negative payrolls, I think, for the Fed put to come in.
That was the next question. The hard data. Payrolls at 8:30 Eastern Time. We started the year in 2025 and we sat around this table and I looked down the camera and I said, I hope we don't squander the confidence. Confidence is sky high. I want to see that translate into hiring, into investment. This country was gearing up for a boom, and you could see that in the confidence in the C-suite. That confidence, unfortunately, as of this morning, has been squandered. It's gone. Sentiment is down here. The hard data is still right up there. Unemployment at 4.1% does not speak to where confidence is at in the C-suite, for corporate America, for consumers around this country right now. How much longer can that spread stay that wide? That's got to be the trillion-dollar question right now.
It is. And I'm sure that's something the market's certainly grappling with that. The Fed's grappling with that, which is why I don't think you're going to hear a lot today unless that number is weak. So as much as I have never cared less about a payroll report than today, because we've just had a big shift from in terms of trade policy, but if that number is weak, and I would say weak is anything less than 150,000 starts to look weak. I think the market's going to say, well, maybe we weren't that strong as we got this uncertainty shock, as we got the trade shock, as we got the Doge shock. Remember, that's also happening in the background. You're getting fiscal contraction, trade changes, and if the economy is not fundamentally strong, and I would look at the hiring rate, that has not been strong for a while. Layoffs have been low, but if company margins, if tariffs are a tax on the consumer as well as the corporate sector, at what point do companies say, I've already cut hiring, I'm going to have to start laying off? So I think, to your point, that spread is going to compress, and I don't think it's compressing towards the hard data. It's coming down. I don't think it's going to take that long. If we don't get the negotiations, if we don't get these tariffs off the table, which you're talking about bilateral negotiations, and it's not really clear what the basis of negotiation is. When you're talking about non-tariff barriers, there's everything's on the table. So if that takes a while, I think the economy is going to respond, and it's going to respond quickly.
I don't mean to be glib, but why is he speaking today? Ultimately, Fed Chair Powell has told us that they don't have all the tools. They don't have all the answers. They also are in a dark room with a blindfold, bumping into the walls like the rest of us. Why is he trying to message anything?
Well, the Fed wants to be transparent. So I think he wants to explain the reaction function. That's really all he can do. He can tell us that he's not basing anything on a model. He heard what happened with transitory. So I think he's going to push back a little bit on inflation. That the Fed has a dual mandate. They're going to look at inflation. They're going to look at the unemployment rate. I think all he can do is maybe be a little bit of a therapist. But I love your point that interest rates can only do that much. Remember the lags as they were raising rates. You didn't see the impact on the economy. It takes, economists argue, 18 months to 24 months. So another hope trade is, the Fed's going to cut rates and lower rates will solve everything. It will help some interest-sensitive sectors, but if the unemployment rate's rising, it takes a while for that to work. I don't think you're going to hear that from the Fed chair. I think he'll want to calm the market down and say, we're looking at the totality of data, but uncertainty is so high, we're not going to do anything. So
What's fascinating to me is there's a discussion right now in markets that maybe traders are pricing in too many Fed cuts by the end of this year, that ultimately they're not going to be able to get ahead of any kind of weakness because of this dual mandate and because it's not going to show up in the hard data. You have kind of an interesting take on that, that maybe they will have to wait longer, but that they will have to cut substantially more. How much more? How much does this give you confidence, frankly, in the U.S. debt market?
Oh, it gives me a lot of confidence that interest rates are not pricing in a recession. If we're talking about 50%, 60% recession odds, where does the Fed take rates in a recession? We can debate when they start to cut. But we've seen the Powell-led Fed is not shy. They hiked in 75 increments when they realized they were a little late. I think there is a risk if the hard data holds up, it takes a few months to show up, they can't be preemptive, meaning that they are not going to start cutting in May, thinking that the hard data is going to worsen. The later they start, the more they have to cut. So I looked at the end point. I think rather than when do they start to cut, the market prices an average of total amount of cuts. I look at that end point. The market's still pricing in now, today, a little below 3%. If we're in a recession, the Fed's going to 2, 1, 0. Maybe 0 is hard because that's a very negative real rate given how high inflation will be, but not 3. 3 is their neutral rate. So the rates market is pricing in a chance of a recession, 20%, 25%, not 50, 60.
Big difference this time. It's not their mess. No one's going to blame them for this situation at all.
Well, no one, maybe, except for maybe some person in the White House, which raises another issue because all of a sudden then it becomes a political motivation of how you message this and where you shift the blame. But you're right. Ultimately, it isn't under their control. People might blame them, but this is not something that's focused on the credit markets, and this is not something that they can fix preemptively.
I hear a lot of people on the conservative side defending the actions that we've seen this week. And I have sympathy with the idea that you should deliver some kind of reciprocity given what's been taking place in China over the last several decades. I think we all have sympathy with the political and economic argument of what's happened throughout globalization over the last several decades. Where there is consensus, though, is how this policy has been executed, how this has been deployed this week, the methodology that was used to come up with these kind of numbers. It makes it difficult to take it seriously. And that's not a good position for any authority to be in.
It makes it difficult for anyone to know what the off-ramps are. People were saying that the more specificity, the better, because suddenly you would understand what the nodes of negotiation actually were. And if you don't have those off-ramps, how do you even price in uncertainty? And how do you even understand how long this could possibly go on?
Priya, it's good to see you. Thanks for catching up with us. Priya Misra there of JPMorgan Asset Management. This morning, 2-year bond yields down by close to 19 basis points. We just broke 350. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg brief. A South Korean court removing President Yoon from office after his martial law declaration. The ruling immediately stripping Yoon of his powers and setting in motion a presidential election to take place within the next 60 days. Elsewhere, U.S. Special Envoy Steve Witkoff meeting with his Russian counterpart in Washington to discuss a ceasefire in Ukraine. The U.S. now waiting for Russia's negotiator to report back to President Putin before moving forward with next steps. And finally, President Donald Trump saying the U.S. is close to unveiling a plan that would spare TikTok from a U.S. ban. The proposal calling for outside investors to own 50% of TikTok's U.S. business, with ByteDance's stake falling just below 20%. That right there is your Bloomberg brief. Up next on the program, preparing to negotiate.
Every country's called us. That's the beauty of what we do.
Are you open to deals with these countries if they're calling you?
Well, it depends. If somebody said that we're going to give you something that's so phenomenal.
Michael Zezas of Morgan Stanley joins us next from New York City this morning. Good morning. Here is your Friday morning price action, down 2.9 on the S&P. On the Nasdaq 100, down by 3 percentage points. On the Russell, down by more than 4. Under surveillance this morning, preparing to negotiate.
It was a sick patient that went through an operation on Liberation Day, and it's going to be a booming country. Every country's called us. That's the beauty of what we do. We put our ourselves in the driver's seat.
Are you open to deals with these countries if they're calling you?
Well, it depends. If somebody said that we're going to give you something that's so phenomenal, as long as they're giving us something that's good.
So here's the latest this morning. President Trump suggesting deal-making is on the table. The president believing economic turbulence will settle now, that the tariff operation is complete. Bloomberg's Wendy Benjaminson joins us now for more. So, Wendy, let's go through the timeline here, what the next week will look like down in Washington, D.C.
Well, I think we're going to see a parade of foreign diplomats or foreign leaders, literally doing exactly what Donald Trump wants them to do, which is come and beg him for relief from these tariffs. I think you'll see American CEOs doing the same thing, trying to take advantage of that comment he made on the plane last night to say, if you offer me something phenomenal, that's great. That didn't work, we saw with China, where last night he said that, he might give China some tariff relief if they, do what he wants with the TikTok deal. But then this morning they slapped 34% tariffs on U.S. goods. So China may be an outlier there, but I think there's going to be a lot of people asking Donald Trump for relief, which is what he wanted, I think, in the first place.
Well, we've gotten some conflicting reporting on that, Wendy. How open is this White House to negotiation? And he said, if we get something phenomenal, how phenomenal is phenomenal, given that there was a lot of reporting that they weren't open to negotiation before April 2nd?
Exactly, Lisa. I mean, that is the uncertainty that Donald Trump really thrives on, the sort of controlled chaos or not so controlled chaos of throwing a bone out there and saying, well, if you give me something phenomenal, and then you have to try to figure out what phenomenal is. But you remember when the TSMC CEO was at the White House and he offered $100 billion, and Trump right there in front of the camera said, how about $200 billion? And the guy was like, yeah, sure. But then Trump just stared at him like, no, how about $200 billion? And then he came back with more. So it's, people will just negotiate to the best that they can, and Trump may or may not be willing to, accede to their wishes, but no one knows. There's only one person who knows, and that's Donald Trump.
Wendy, appreciate the update. As always, Wendy Benjaminson down in Washington, D.C. With us around the table, Michael Zezas of Morgan Stanley. Michael, good morning.
Hey, good morning.
This is tough. For a lot of people, it's so bad it just won't happen. Is that your position on things?
Well, I think there's probably plenty of room for negotiation. We just don't know what the parameters are, right? So one would expect that lower tariffs, potentially asset purchases, potentially more military spending in some of these situations might help. But really, we're in this discovery process right now of what the sufficient conditions are. Unfortunately, and I don't think this will clarify anything for anyone, they're probably different conditions for different countries. So we shouldn't go into this, at least from my perspective, thinking that any of these negotiations will go quickly or any of this tariff relief will come about quickly. And so we do need to price in at least most of the negative consequences of these choices.
What is the significance of the formula that this Trump administration used to come up with the tariff rates on each country?
Yeah, I mean, I only know what they've told us, which is effectively that it's supposed to be a representation of the trade deficit, and that in a theoretical world where if tariffs are equalized, that there would be no goods trade deficit. That said, I don't know if the information we're supposed to take from that is that their end goal is to just get goods trade deficits down to zero, or if just that they apply the methodology and they're willing to talk about it. Again, I think we're in that discovery process over the next week. But either way, it doesn't seem like we're going to get relief quickly from any of this.
I was speaking with an investment manager yesterday, and I said, what is your methodology of taking all of the data that we're getting it and ranking it, et cetera? And they said, I run a lot. I run frequently. What on earth are you telling your clients?
Yeah, I mean, listen, I think what we said coming into the year was that we did think that higher tariffs were going to be a fixture of the U.S. policy posture. We thought it was going to be mostly aligned with China, and kind of rest of the world would be a lighter touch. I think that's still generally true, but the China tariffs happened faster than we thought. We did think they'd get to 60%, but we thought that was kind of an early 2026 event. And rest of world would sort of be product by product and lighter touch. So the new thing we have to bake in here is rest of world tariffs are higher. There's at least that 10% minimum, and then there's higher levels on top of that. Maybe some of that gets negotiated back. But that means there's a weaker growth outlook than we would have anticipated. So now we have to price in weaker growth, higher recession probability, And unfortunately, I think most risk markets just aren't priced for that reality yet. Some of the stuff becomes positive catalysts once you've priced that in, but we're not quite there yet.
Do you entertain the theory that this was about getting the bad stuff out of the way, getting rates down, getting bond yields below 4%, down towards 3%, before they come out with a massive tax plan? Do you entertain any of that?
I tend to look at this more as it was a sequencing of what was available to them politically and sort of legislatively going into this, right? So, because you could sort of make a theory that, hey, why don't we just do the tax cuts first and create space to operate and incur some of the pain around tariffs in the effort of kind of this grand remaking of the economy.
That's what people hoped for.
Right, but I think practically speaking, the ability to actually extend tax cuts and or do more wasn't going to be on offer early because you had to work through the budget reconciliation process, really slim majority. So you work with the things that are in executive control, which is tariffs, because that's open to you. And the legislative stuff was just always going to take longer. So I don't know if there's a lot of rhyme or reason to it other than the administration's doing what they can do with the tools they have available in service of their medium-term goals. And this just happens to be the sequencing of it.
The challenge at the moment for a lot of us is to kind of put markets to one side and think about where we'll be 12 months out.
Yeah.
In 12 months' time, when you've got your hands around the more complete policy platform, not just trade, but taxes as well, what's the mix going to look like?
Well, listen, there's two ways to think about this. It's like, are you better off 12 months from now than you would have been if these choices haven't been made? I think that's an open question, and I think answering that question isn't necessarily relevant in the sense of the real question is, can we price in the kind of negative effects of making these policy attempts? And once you've done that, can the policy choices you make to kind of ease that get it better? So if we were to kind of fully price in higher recession probabilities, weaker growth outlook, and then some of these negotiations on tariffs work out, and then maybe we get a bigger tax cut than we anticipate, because right now we think it's going to be mostly an extension of the TCJA. Those things can be positives on top of pricing in negative outcomes, but I think we have to go through the pricing in the negative outcomes first.
Yesterday, there were a lot of historic kinds of comments, a lot of catastrophic rhetoric, sea change, the loss of U.S. exceptionalism. Did you take comfort in the fact that Treasuries rallied, and John mentioned this earlier, that even though people were talking about boycotting U.S. goods or boycotting the U.S. dollar, you did see yields go lower as a haven trade?
I mean, it's all obviously an incredibly large and liquid market, and it makes sense that in times of uncertainty where growth expectations are weaker, that you would be buying more treasuries. I think that to us was sort of never in question. I know there are sort of hypothetical longer term concerns, but that's why we've had this preference for fixed income over equities coming into the year and then throughout all of this. I think that's still the way to be positioned right now.
That's the silver lining for me. I know it wasn't your base case, but I'd be extremely worried if we woke up one morning and you had all those people that were running around saying, we're going to see an exodus of money from the United States. People are going to dump dollar-denominated assets. They're dumping equities because that's associated with growth. I don't think there's a sign here that they're dumping dollar-denominated assets because of the policy volatility, because that would show up in treasuries too. And that is what would really concern me. And that's the silver lining, I think, from the cross-asset price action of the past 24 hours or so.
That at least the United States is not acting like an emerging market in this respect, because that's exactly what we would see.
You saw the dollar weakness, but
right.
The dollar weakness accompanied with a bond market sell-off would be getting my attention in a much more negative way, and I think it would get the Federal Reserve as well.
We're a far way away from that, and the United States still is the dominant market, which goes to this idea of how do you get perspective at a time of a lot of superlatives.
Let's hope we never see that.
Yes.
Let's be very clear about that. Michael, thank you, sir. It's good to see
you.
you. Michael Zezas there of Morgan Stanley. Up next on the programme, Aditya Bhave of Bank of America as we count you down to the payrolls report, 8:30 Eastern Time, 1 hour and 4 minutes away. The biggest one-day drop since the pandemic, and the drop continues. Equity futures negative and down across the board. Session lows. We're down 3.7% on the S&P. On the Nasdaq, down another 4 percentage points. On a Russell, we're down by 5.3. Let's get you some movers and start with Delta. Next week, we'll get a report from them. Earnings on Wednesday. They're down another 4.5%, down 10% yesterday, down 36% year to date. And Bank of America cutting price targets across a bucket of names, looking for super conservative guidance from these airlines over the next few weeks.
Which is something that we've already heard some sort of taste of. United shares lower significantly more than 10% yesterday, as well as people look forward to this idea of low consumer confidence translating into less travel. And Canadians, they're not traveling to the U.S., so that, takes a hit too.
Can we curse on air? RH, Restoration Hardware, down 40% in a blink of an eye yesterday, down another 8 percentage points so far this morning. There was a call that the CEO was on. You've heard the story, I know. Sees the stock and it's, not good.
Yeah, it's a four-letter word that begins with S and ends with T, and that's what he said. It was their moment, and this is ultimately what they're dealing with softer consumer demand, and they are uniquely affected by all of the potential tariffs. And you saw this with every single company that was potentially exposed to that, seeing pretty significant downdrafts.
These are companies that insulated themselves from China risk, moved the supply chains to places like Vietnam. We saw that with other companies as well. And now they're in a position where they can't hide. And they're also in a tougher position now because the wage differential in some of the places they operate is so much greater here in the United States that they'd be better off staying where they are and taking the tariff hit than moving production here and taking the wage hit. That's the problem, the challenge for so many of these retailers at the moment.
Which is the reason why there's just paralysis. And ultimately, at a certain point, how do you get out from ahead of this if you don't know where the off-ramps are, where your potential leverage will come from? It is interesting to see that the investors are really differentiating between those that have exposure to, say, China and overseas imports and those that don't. And you are seeing that, say, Dollar Tree, Dollar General, total discrepancy. I mean, there are some interesting patterns that are emerging in markets.
Tech is having a tough time of it too. We talked a lot about Apple. Let's talk about Tesla. It's down again this morning in the pre-market. We are negative by close to 7 percentage points. It's having a really difficult year already. Only back in November, December time, we'll be talking to the bulls on this name, and they were talking about the halo effect that came from the Trump administration. Stories changed so much in the past few months.
Now the halo effect has something more like horns, just based on the fact that Elon Musk has a pretty negative opinion rating in some of the recent polls, and he is associated with this brand. At what point can he resurrect that with stepping back from the company? At what point is this name just going to be caught up in the Magnificent Seven downdraft that has been 24% since the peak late last year?
Wanted to finish on the bond market. Check this out. 2-year, 10-year, 30-year. So this morning, equities were lower, bond yields were down 2. And then we saw the prospect of China retaliating with their own tariff of 34% on US imports. And we just cratered. We're down by 20 basis points at the front end of the curve, down 15 on 10s. Payroll 60 minutes away. The estimate's 140. I don't know if you even care about that this morning. If it's stronger, you're just going to sit there and say it'll be the last strong one. And then you've got Chairman Powell coming later at 11:25.
If it's strong, potentially, it's going to be even more of a problem because then Fed Chair Jay Powell can't even indicate that he's recognizing softness in the data and will be responsive to it. Right now, I'm looking at credit risk, surged the most going back to June of 2020. All of these metrics are flying out to levels that we haven't seen since the pandemic, and yet we have heard from Chair Powell before that he looks more at the hard data than he does the soft data. So what do you do with this? And how does he really spin this forward in a way where he can be the off-ramp for a problem that he didn't create and that, frankly, he doesn't have the tools to address?
We're hearing from Secretary Rubio, who just moments ago said that markets will adjust to US tariffs, and markets are adjusting to US tariffs. On our radar this morning, President Donald Trump saying he's open to negotiations for cutting back tariffs. Trump telling reporters he'd consider lowering tariff rates for countries that offer something, quote, phenomenal in return.
Do we have any sense of what the parameters of phenomenal are? And this goes back to this question of we can have a discussion about how to create a more fair trade situation. And I think a lot of people would entertain and agree with that premise of a discussion. But there is a question of how the tariff rates came out and where the details were for people to offer something phenomenal. We don't even have a sense of whether that's having to do with TikTok, whether that's having to do with cars, whether that's having to do with wine, cheese. And that's very difficult for people to really understand.
Annmarie was on Air Force One with the president yesterday. And when he came out to speak with the press, he wanted to talk about the golden visa, the so-called gold card with his face on. That was the first thing he talked about. He did not look unnerved at all by the way this equity market was reacting to the tariffs that were announced the day before.
He said it was expected. He said it's pretty much in line. And this makes people even more nervous because typically when there is nervousness, there is a response. And right now, it doesn't seem like this is something that the administration is going to push back on.
People think Chairman Powell will respond. Traders are adding to Fed rate cut bets in the aftermath of the announcement we saw in the past 24 hours. And markets are now pricing 100 basis points worth of cuts plus by year end, with expectations that tariffs lift inflation and slow growth, but that inflation hit won't last that long. And that's the bet. That's the bet implied by the forecasts in the SEP from the Federal Reserve only a few weeks ago.
That they will view this as transitory and they will cut on weakness. Priya Misra, on from JPMorgan just moments ago, she had a fascinating take on this. They're not going to be preemptive. They're not necessarily going to cut so soon, but when they cut, they're going to cut a lot more than this market is expecting, because ultimately this is a Fed that is not shy about responding to recession. And should they essentially start to see it in the data, that is basically what they're going to be dealing with.
Seeing it in the market, commodities getting hammered. Crude down by 8 percentage points this morning. WTI 61, threatening to break into the 50s, which is unreal. Brent crude down by more than 7%. We're down this morning to about 65. Wanted to squeeze this story in as well. The EU preparing major penalties against Elon Musk's X for violating a law combating illicit content and disinformation. The New York Times reporting regulators are weighing a fine of over $1 billion plus demands for product changes.
Yeah, so this has been in the works for a while. It's both this idea of the EU going after U.S. technology companies, but it's also a question of retaliating against specific companies that are U.S. companies as retaliation, just to sort of emphasize the China point, because the China retaliation is part of what's driving markets a lot lower. And there's a question here about how much China and Europe are going to go after specific companies in the U.S. as retaliation. China mentioning 11 companies in the U.S. that are now on the unreliable list.
This has the potential to get out of control. I mentioned this briefly in the last 10 minutes or so. I think we have to draw a distinction between a shock to the cycle and a shock to the system. It's clearly a shock to the cycle. You're seeing growth priced lower. You're seeing that in equities, in bonds, in commodities as well. The shock to the system will take much longer to internalize. Much, much longer from here. That's the weeks, months, years story. That's very, very difficult to price. That involves things like shifting away potentially from dollar-denominated assets. That speaks to the weakness we saw in the dollar yesterday. But I want to keep going back to the same point. We aren't seeing treasuries being dumped. And that's the one thing that would really, I have to use the word, that's the one thing that would really scare me, to wake up and see that. And the fact that we're rallying as hard as we are in the treasury market speaks to the idea that at the moment, at least, it's a bigger shock to the cycle than it is to the system, because the tariffs aren't even on yet and may not be on at all for very long.
And the truth is, you cannot move a global system this quickly. That right now, this is a global system that is pegged to the dollar, that is pegged to the treasuries, that is pegged to a U.S. market that is the deepest, most liquid market in the world, and that frankly offers the swap lines to the rest of the world. So people can have big, catastrophic ideas, but can you implement them at a time where the economy and markets cannot move structurally as quickly as proclamations or bills or tariffs can be put on or put off?
It's really, really hard to price the latter. It takes a long, long time to price that story. We're certainly pricing a shock to the cycle right now. Equity futures are down by 3 percentage points on the S&P as we count you down to payrolls due in just 1 hour's time. The median estimate in our survey calling for an increase of 140,000 jobs. Aditya Bhave of Bank of America calling for 185K, but saying, quote, risks to our forecast are very much to the downside. Aditya joins us now for more. Aditya, good morning to you, sir.
Good morning. Thanks for having me.
Is this the last good one, is the question a lot of people are asking.
Right, that is a great question. So one of the reasons that we have some strength in this jobs report is we expect payback in leisure and hospitality hiring. That was really soft in Jan and Feb, but it was very strong going into the end of the year. So we think that the Jan and Feb effect was probably weather related, and you can get some payback in March. And then the other thing that we're seeing in the claims data is that you're not really seeing a slowdown, right? So claims are still low. That's true for federal claims. It's also true for the number that gets more widely discussed, right? We're still in the 220s.
Chairman Powell, 11:25. What does he say about all this?
So I think the question that we all want to hear Powell answer is how will the Fed respond to stagflation risks? You mentioned earlier that the markets are looking for aggressive front-loaded cuts, but I'm kind of more in the other camp, right, where if the Fed has to go, it's going to be a little bit backloaded, and then they might have to go very fast. Because the issue with stagflation is it's almost like your two kids are running in opposite directions and you have to decide which one to chase, right? So initially, inflation's already above target. I do think they have to maintain their credibility on inflation. As long as inflation's going up, especially if the tariffs are implemented as announced and we're heading towards 4%, then they have to focus on that. They have to wait until inflation peaks out. Maybe it starts rolling over a little bit, and then they can focus on the demand side.
So why do you think Fed Chair Jay Powell said transitory? Do you think that he's going to try to put that back in the bottle today?
The context of that statement was interesting. If I remember correctly, I think he said there's a chance that it could be transitory or something like that. And there's no reason for him to conclude that it absolutely can't be transitory, right? But I do think the Fed is a little bit scarred by its previous experience from 3 years ago, where it insisted that the supply shock was transitory, and it in fact wasn't. So I'm not sure they would jump to that conclusion so quickly.
There's also this feeling that there's either a Fed put or some sort of policy put from Washington, D.C. And it used to be that someone would panic about markets selling off in free fall like they are over the past couple of days. We don't get the sense that anyone is. Is Fed Chair Jay Powell going to be concerned about this from a sentiment perspective, given that so many households are really leveraged to the stock market, both in sentiment and, frankly, for retirement as well?
So that goes back to the stagflation issue. I think it's easier to respond to financial conditions when you see it purely as a demand shock. When the driver of weaker financial conditions is a supply shock, go back to 2022, right? Markets cratered, the Fed was hiking because they had to respond to the inflation shocks. I think it's something similar for Powell right now, where one, consumer sentiment has been a terrible indicator of consumer spending. So we need to keep that in mind, and we need to keep in mind the fact that consumer balance sheets are still, there's still plenty of room there to accommodate some sort of inflation shock. At some point it could get out of hand, folks could lose jobs, and then I think it'll be much harder. But for now, Powell has to say, look, the hard data are holding up, and if anything, the hard data on inflation are not behaving as well as the Fed would like.
Are you seeing signs, based on the speeches you've read and heard, that they're conditioned by what happened in 21-22, and that would mean they wait longer than maybe some people think they need to?
I think we're getting the same message from the Fed for now. It's all just wait and see. Let's see how the tariffs play out. Let's see how much they impact inflation. Let's see how much they impact economic activity. And let's not jump to conclusions. So as long as this labor report is fine, you know, it's on to the next one. It's on to the next inflation print. And I'm not sure that they'll be swayed just by financial conditions.
And the market's down another 5, 10, 15. Who knows how many percentage points? If you are just joining us, welcome to the programme. We've got equities lower by 3.4% on the S&P. We've got crude down by 8 percentage points. Bond yields lower by 16, 17 basis points. The payrolls report about 48 minutes away or so. If you are just waking up, earlier on this morning, a headline from China announcing an extra 34% tariff on US goods that kicks in on April 10th. So your calendar now looks like this. On April 5th, the baseline 10% tariff kicks in. April 9th, the additional reciprocal tariffs kick in on the US side. And China is saying, we're going to have this stick ready for you on April 10th, a 34% tariff on all US goods. And you'd imagine this sets the stage for the negotiation to take place between now and then, without any sign, at the moment at least, that those negotiations are taking place, Lisa, between the US or China at a high level.
And we don't have a sense of what the off-ramps are. And the reason why this is catalyzing such declines across the board throughout global markets is once you start the tit for tat, it is hard to get that back under control, especially if you don't have an understanding of exactly how to alleviate some of the pressures. It's interesting that yesterday we were talking about how a lot of the pain was concentrated, focused on the United States as taking the biggest hit. Today, it is a global shock, and we are seeing this globally with markets falling. You're seeing credit spreads widen at the fastest pace going back to 2020 at the peak of the pandemic concerns. And there is a question of exactly how people even begin to reprice something that could be so sustained and that has such levels of uncertainty that we have not seen before.
We're seeing a lot of cuts to estimates over the past week or so from SocGen, Barclays, Edjardeni twice, Goldman twice. RBC now twice. They've done it again. Lori Calvasina dropping her price target to 55.50 from 6,200, saying that the old bear case is now the base case. UBS, as you mentioned earlier on this morning, Lisa, they cut as well from 6,400 to 5,800. But yet still, as we indicated throughout this morning, a belief that by the end of the year, the stock market will be higher than it was from here. Because at the epicenter of Wall Street at the moment is a belief that these tariffs that were announced earlier this week won't go on, and if they do, they won't stay on very long.
which I thought was interesting in a survey of economists done by Bloomberg yesterday, that 92% of them think that the chance of recession has increased, but 58% think that there is a great likelihood that we are going to get some sort of trade deals that result in lower tariffs by the end of the year. I will say you are starting to see potentially signs of this in the hard data that are coming out. Yesterday, I thought it was interesting, and maybe I'm making too much of this, so please, I welcome all comments, but continuing claims came in at the highest level going back to 2021. And what some people interpret this as is that companies don't have the conviction to hire. And it leaves this question of how do you move forward with an economy where companies don't have that conviction? And that, I think, is a big concern.
Once you're out of a job, it's harder to get a job. And that's what you're seeing in continuing claims. And what we've seen in data elsewhere so far this week, factory activity contracting, services ISM below expectations, the employment component negative as well. That does not make for good reason going into the payrolls report a little bit later this morning. Aditya, it's good to see you. Thanks for dropping by. Aditya Bhave there of Bank of America. Equities down near session lows. We're lower by 3.6%. Up next on the programme, betting big on the Fed.
As things stand now, we're headed to recession. A lot can happen, but if these policies stick for the next quarter or so, then you have to start pricing in the Fed brings down rates to 2.25%, 2.5%.
We'll get you some insight into the Federal Reserve in just a moment from the former Boston Fed President Eric Rosengren from New York City. This is Bloomberg. Equity futures right now negative by 3.4% on the S&P. Payrolls just around the corner. The Nasdaq down by 3.7. The Russell, the small caps, down by close to 5 full percentage points as China prepares to retaliate, announcing an extra 34% tariffs on US goods. Look at how this is showing up in equities over in Europe. Check out the DAX in Germany. We're down by 4.7%. Check out the move in Italy. The FTSE MIB down by more than 7 percentage points. And if you lift the lid on the Stock 600 and break it down, sector to sector across the index, banks are down 9% in Europe this morning. Speaks to the move in crude too, Lisa. Down hard there as well, by almost 9% on Brent. This is about a real shock to the global economy, to the cycle. The prospect of growth rolling over aggressively and repricing a growth story, with crude down by 8 percentage points to 64 and WTI threatening to break into the 50s.
And you're seeing this trend across commodities with copper down 5%. You see this elsewhere as well. I will say what you just highlighted was a global weak story. And that, I think, is the key one. Yesterday, people were talking about the U.S. experiencing the brunt of the shock. Today, we are talking about a global downturn in growth that's being priced in across asset classes.
Under surveillance this morning, betting big on the Fed.
As things stand now, we're headed to recession. The Fed already told us a couple weeks ago that, yes, it's not pleasant to have this cost push inflation, but they'll look through that. They're more concerned about the downside. A lot can happen, but if these policies stick for the next quarter or so, then you have to start pricing in the Fed brings down rates to 2.25%, 2.5%.
So here's the latest this morning. Traders increasing expectations for Fed rate cuts. The view from the former Boston Fed President Eric Rosengren looks like this. He writes the Fed may be slow to react, given uncertainty around the trade policy and the likely significant impact on reported inflation over the next 6 months. Eric, welcome to the program, sir. Lucky for us to lean on your experience. How misplaced or well-placed is that bet on that Fed cutting rates?
I think it's a very challenging environment for the Fed. First of all, while the tariffs have come on and are quite significant, the retaliation is just being announced now. We had China today, but Europe is certainly going to be retaliating as well. The question is, how long are these tariffs going to be in place? The administration has been pretty unclear as to the purpose of the tariffs. If the purpose is to raise taxes and bring manufacturing here, the tariffs need to be permanent. If the purpose is a negotiating tool, then it's going to be temporary. So the Fed, first of all, has to be concerned that the shock that's occurred could be offset pretty quickly by, if tariffs are a serious policy mistake, the most efficient way to address that problem is for the tariffs to be taken off. In the event that the tariffs are kept on and look more permanent, then you have an environment where both the unemployment rate is going to go up and the inflation rate's going to go up. The inflation rate is probably going to start showing in the next couple of months the effect of tariffs. It's a tax. It's going to go through relatively quickly. There's some goods that are probably already being repriced in reflection of the tariff changes. The unemployment rate effect is likely to be a little bit more slow moving. So given the uncertainty around what the policy actually is, and given the fact that the first impulse is likely to be on the inflation side, I think the Fed is going to be very reluctant to move very quickly. If it looks like we are actually going to go into a global recession where the unemployment rate in the United States goes up quite significantly, then that's a situation that the Fed obviously has to react to. But hopefully there are other off-ramps, including changes in fiscal policy regarding tariffs, that will avoid that. I think the last thing the Fed wants to do is perpetuate a view that inflation is going to be tolerated over 3%. I think it's quite likely that we're going to see a 0.5% increase in core PCE over the course of this year. And that puts us over 3%, puts us at 3.3%. Yeah. That's not an inflation rate consistent with the Fed's target. And I think it's going to make the Fed very reluctant to move quickly to address some of the concerns that are occurring in financial markets and are likely to be occurring in the unemployment rate over time.
Just quickly here, I'm wondering if you think then that the Fed is destined to be late, and if they cut much more on the back end.
If the unemployment rate starts going up dramatically, it'll cut a lot in the end. That's a really bad outcome if it gets to that point. But I think they're going to move slowly, gradually, and reluctantly. And when they move, if it's because the global economy is going into a deep recession, I think it will have to then start moving quickly to bring interest rates down. Unfortunately, it's unlikely to immediately be able to offset the nature of the problem, which is bad tariffs. And one thing people are not talking about is developing countries are likely to be experiencing a financial crisis. Many of the poorest countries in the world are getting the highest tariffs from the United States. And that could exacerbate the international composition of what's going on.
That's the last thing we want to see this morning, that's for sure. Eric, appreciate you jumping on this morning. Thank you, sir. The Boston Fed president, the former Boston Fed president there, Eric Rosengren, breaking down the Federal Reserve decision. They are in a tough spot. We're going to hear from Chairman Powell later on this morning, 11:25 Eastern Time. Before we get there, we've got a payrolls report, 8:30, 34 minutes away. Up next, Nadia Lovell of UBS, Stephanie Roth of Wolfe Research, Jeff Rosenberg of BlackRock, and Mohamed El-Erian of Queen's College, Cambridge. The third hour of Bloomberg Surveillance is up next.
This isn't really going to start hurting until the middle of the year.
Tariffs will be a net negative across the board. It's undoubtable.
This really can't be a surprise. The reality of the surprise is a little bit more painful for everybody to digest.
As things stand now, we're headed to recession. And it's very clear that this is a tax on businesses and households.
If the US is going to be in a waning economic environment, then it's most likely going to drag the rest of the world with it.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
90 minutes away from the opening bell, 30 minutes away from the payrolls report. Live from New York City this morning, the third hour of Bloomberg Surveillance starts right now. And your scores look like this. Equity futures on the S&P 500. The good news, we're off the lows. The bad news, we're still down 2.8% on the S&P. On the Nasdaq, we're down 3. On a Russell, we're down 4. Over in Europe, we are not spared. In Europe, we are down and down hard. The DAX is down 4. In Italy, we're down 6.5 as China pledges to retaliate with an extra 34% tariff on US goods, which would kick in a day after the US puts additional tariffs on them on April 9th. How's it showing up elsewhere? In the bond market, double-digit moves across the curve, down 11 basis points on twos to 356. The move was almost 20 basis points lower in the last hour, so we've trimmed some of that move too. We're down 11 on the US 10-year to 392. And the towel is in the commodity market. Crude right now is down by 7 percentage points. WTI is down by 8, 61.60. This market is very concerned about growth. Maybe not as concerned about inflation. Going into the payrolls report with estimates like 140 in our survey, how meaningless is this payrolls report when so many people on this program already this morning are saying this could be the last good one if the tariffs go on and stay on? And then this man right here has got to talk about it. Chairman Powell, 11:25 going into the weekend, gets the final word. What on earth does the Federal Reserve Chairman say about the position that this global economy is in?
Everyone agrees that he is in a pretty tenuous position. Maybe if the payrolls report is negative enough, he can talk about downside risks to growth and how they can potentially address that. But at a time when we still have not gotten inflation to 2% and they are facing a dual mandate of both inflation and employment, a sticky employment market that really does hold up, at least in the near term, puts them in a bind. There is a key question right now. What is the off-ramp for this concern that we have in markets that this trade war could get out of control? And right now, people are having a hard time finding it.
Let's go back a few Wednesday. Chairman Powell sitting in the news conference and he uses the T word. He looks at the forecast and a lot of people think they're implying essentially it's a one-off hit to inflation. By the time you get back to 26 and 27, inflation comes back down towards target. They can reduce interest rates. That's good news. The chairman reflects on the soft data, the sentiment survey data, and basically implies he wouldn't put much weight on it and says the hard data is still holding up. Well, at 8:30, a lot of people still think the hard data is going to hold up. Can he actually sit there today, put a speech together and say unemployment's still 4.1% and there's nothing to see here? I don't think he can do that this time around, can he?
I don't think that he wants to. He wants to say that right now they're looking at a labor market that's coming from a stable place. But as a lot of economists have pointed out, it is a stagnant market where you have macroeconomic paralysis. That was Jim Zelter's comment yesterday from Apollo. How much can companies really have the conviction to massively hire people? They might be reluctant to fire people at this moment. That's not a healthy market for this Federal Reserve at a time where there is so much anxiety. At the same time, inflationary concerns picking up. The one-year measure of inflation swaps in the United States reaching the highest level yesterday, going back to 2022.
We're all hoping for negotiations. April 5th, tomorrow, we're set to see the baseline 10% tariff kick in. April 9th, we're looking for the additional tariff on top of that. So we're talking about 20% tariffs on the EU, 24 on Japan, 34 on China. And China basically saying this morning, if you do that, the day after, we'll go 34 too. How much negotiating can be completed in the next week is a big question for this market, with us down 3 percentage points on the S&P 500 at the moment. Coming up this hour, we'll catch up with Nadia Lovell of UBS as stocks look to recover from their worst day since 2020. Stephanie Roth of Wolfe Research on why she's lowering her GDP forecast. And Mohamed El-Erian of Queen's College, Cambridge, reacting to the payrolls report that drops at 8:30 Eastern Time. We begin this hour with stocks lower following their steepest one-day slide in 5 years. Nadia Lovell of UBS writing, we now look for a period of much slower economic growth and extended market volatility. We reduce our year-end target to 5,800 from 6,400. Nadia joins us now for more. Nadia, good morning. Good to see you.
Morning.
This has been a week, hasn't it?
It has been a very volatile week.
What's changed for you then?
I think what's changed is that these tariffs have come in way higher than even our worst case scenario. I mean, we were sort of looking for the opening salvo to be in the low teens effective tariff rate. There are close to 25%. And we think that they could go even higher. Remember, retaliation is already happening. We're having that tit for tat. And then remember that the president has still said that there is Section 232 investigations that need to happen on semis, farmer, lumber, copper. So there's still potentially more tariffs to come. So reality is this now puts the economy in a situation where we are going to see much lower growth. And so we have to take down those estimates to reflect that. You know, we were looking for sort of trend line 2% growth this year. It's probably lower than that, lower than 1%, and we could even get down to 0% growth.
Do you consider this an adverse regime change or the start of negotiations to take us to a better place?
We hope that it is a start of a negotiation. So far, the administration seems to see that, but I think we're all debating what does the off-ramp look like and what does the administration really want, because we know that these tariffs were calculated in a pretty peculiar way, to say the least, in terms of as a percentage of the trade deficit. And so some of these nations, particularly these Asian nations, that has made the cost of living lower for us here in the United States and other wealthy countries, what can they really offer? And is it about investment in the U.S.? Because we had TSMC that upped their investment, $165 billion. We had SoftBank, earlier this year in terms of the Stargate, investments. Even last week, the additional capital raise in OpenAI. And so it's trying to figure out what can these countries offer the president to backtrack on those companies that have already, promised concessions. And yet you have, Taiwan hit with 32%. You have Japan hit with 24%. So it remains to be seen what maybe the off-ramp is the American consumer.
So are we getting close to a buying point? I mean, I say this because you have this goal of, you did downgrade your expectation to the target of 5,800, and you said that we think that S&P 500 levels of 5,000 to 5,250 could be an attractive entry point. We're getting pretty close today in futures. So how do you have conviction to buy, given everything you just said?
It's hard to have conviction to buy. You might remember, Lisa, we talked about coming into this year having a tariff shock scenario of 5,100 on the S&P. It looks like we're going to be testing that. And so that could be a level where you start to look to maybe nibble. However, right now, our focus is really focusing on, income yielding equity structure products, because we think that that can give you some downside protection, but yet still offer you some upside participation. Because remember, all of this could change with one headline for the better or the worse. And so you have to have some protection, and it's difficult to call the bottom right now.
Can it change with one headline? And this is what I want to examine, this understanding that can it all just be put back in the bottle? And to me, when you take a look at the sell-off this morning, how much is stemming from the tariffs and how much is stemming from the idea that this is going to potentially get out of control with a tit-for-tat type of trade war that is very difficult to end?
So, we heard the president say phenomenal deals, right? Could include like a TikTok. So we know that that's coming up. So if something that he might be willing to ease back on the tariffs concerning China, if you can get approval there. So that's one headline could change it, in terms of if there's a deal and the president starts to step back and starts those real negotiations. As we know, the market is a forward-looking instrument. So if there's any inkling of that, there could be negotiations that meaningfully bring this down in the next couple of months, you will start to see the market recover from that. But if we're sort of in this stalemate, this is a huge impact to earnings. This is potentially recessionary if these tariffs remain in place over the next 3 to 6 months. We're talking about double-digit downsides to earnings and also a recession that you could see this market get to 4,500.
What's the guide for earnings now? Down to Wednesday. JPMorgan next Friday. What do they come out and say?
Look, our internal conversation is that we think that this is a kitchen sink quarter in terms of forward guidance and potential for guidance to just totally be pulled. I mean, our consumer analyst was at JPMorgan Consumer Conference this week, and some of these companies have literally said they have thrown out their playbook as of Wednesday. And so it'll be interesting to see. But reality is, who can speak with any conviction when there's so much uncertainty? So companies are more likely to pull.
How much things have changed? Start of the year, we're in Davos, Switzerland for the World Economic Forum. These bank executives are running around Davos, Switzerland, talking about how great things are, how powerful the story is in America. And to give them credit, there was good reason for that story. You had an administration coming into power that many people thought was going to be pro-growth, pro-risk, deregulation, tax cuts. Sentiment was sky high. And now we're sitting here and saying that they're going to come out after first quarter earnings and pull guidance. That's how much things have changed in just 3 months?
I think that's how much things have changed in 2 days, Jonathan, right? Reality is coming into this. Most people thought that, the 10% potential effective tariff. And so we're in this situation where things could change day by day. And that's what makes it a challenge. And that's partly why you might remember we were quite bullish on financials, right? In one of the best performing sectors since last summer, we took that down to neutral because there is risk to the downside if we end up in a recession. That's hit to banks, and that will offset some of the potential positive that we could get, who knows, in the second half of the year around deregulation and potential for capital returns.
I'm smiling because everyone's saying this is going to be a kitchen sink quarter. So I'm expecting people to announce frauds, affairs with secretaries, et cetera, because ultimately no one will care. It'll sort of be the time. If you have a fraud or if you have, some kind of malfeasance, now is the time to report it because everyone will be sufficiently distracted. In a more serious note, does the jobs report matter in any way, shape, or form, given this backdrop?
If it's weak, absolutely, because that means the recession is probably, on its way, already started. If it's strong, who cares? Because the reality is Wednesday's announcement was a seismic shock to the market. It is yet to see the aftershock in the economy, the consumer confidence, corporate confidence, et cetera. And where we end up on that Richter scale will depend on the president and the administration, how much damage and how much gambling they're willing to do with the U.S. economy.
It's never a good time to reveal the affair with the secretary, is it?
Well, I actually think that right now, if someone has...
You're not going there, Nadia, don't worry, I'm not going
there. You really want him to go there? But I'm just thinking...
There's something a little bit lighter this morning. Everything's so heavy and dramatic.
If they're going to really kitchen sink it, let's see what else they can come up with.
Maybe not that much. Neil Dutta of Renmac writes in, here's his latest note. Why does anyone think this is over soon? Goes on to say, if Wall Street stops panicking when policymakers begin to panic, then we should not hold our breath. President Trump cannot back off. If he did, he would look weak and there is no coming back from it politically. And at the very end of the note, he says this, I am increasingly of the view that this ends when Congress reclaims its tariff authority, but maybe I am too pessimistic.
He might be too pessimistic or he might be correct. Right now, the fact that there is that range of possibility gives you a sense of the range of options. To his point, Marco Rubio, U.S. Secretary of State, saying, as you mentioned earlier, that markets will adjust. No one seems particularly phased. And it is hard to see how President Trump backs down and says, OK, if you're going to put 34% tariffs on us, we'll come to a negotiating table. That isn't the tenor of these discussions.
Nadia, it's good to see you. Great to catch up. Nadia Lovell there of UBS going into payrolls later this morning. That report is 17 minutes away. Equities are lower by 3 percentage points. Up next, we'll get you some morning calls. Plus, we'll catch up with Robert Tipp of PGIM Fixed Income as we count you down to the payrolls report. And as Sarah House of Wells Fargo indicated earlier on this morning, that payrolls report may well be the last good one. From New York, this is Bloomberg. So we have had price target cuts on the S&P 500 so far this morning from UBS, again from RBC. Lori Cavacina comes down to 55.50 from 6,200. Bruce Kasman saying there will be blood if these inflation tariffs go on. Obliteration day is what Renmac calls it. Neil Dutta, brutal in the last 24 hours or so, and equities keep falling. On the S&P, we're down by 2.7%. On the Nasdaq, we're down by 2.9. On the Russell, we're down by close to 4. Let's get you some morning calls. Canaccord cutting its price target on Yeti to 35. The analyst citing tariff impacts and competitive threats in drinkware. Your second call from Truist lowering its price target on Wells Fargo to 84, looking for EPS cuts due to tariff impacts. And finally, Citi cutting Nordstrom to sell, citing unfavorable risk-reward due to the pending take-private deal by a Mexican department store chain. That's random. They've got bigger problems, I'm sure. Nordstrom right now is down by 2.6%. The whole sector's got bigger problems right now, that's for sure.
Yeah, that's the reason why a lot of these retailers lost about a quarter of their value or a little bit less yesterday in one day on the potential for supply chain. So maybe, these deals will be refreshing to discuss.
As we count you down to the payrolls report, it's just moments away. Robert Tipp of PGIM writing the following. In the wake of the tariff announcement, investors will anxiously await hard economic data. Central bankers, too, will be struggling to evaluate the expected impact of tariffs on growth and on inflation. Robert joins us now for more. Robert, welcome to the programme, sir. That payrolls report's 13 minutes away. For you and the team this morning, what's your approach to that data point? How relevant is it?
Right. Well, I agree that downside, showing up in the numbers right now, in things that have occurred prior to April 2nd will be very worrying. So far, that's been limited. There's been some hit to confidence. The Challenger layoffs yesterday surged, but those were government jobs. So it's so far so good. People are going to look through strong data like they did with ADP and other data this week. But they're going to be very sensitive to the downside, as are the policymakers, I think.
Well, let's talk about the policymakers, because Chairman Powell, as you know, speaks later on this morning. Are you expecting a repeat of what you heard in the Federal Reserve news conference only a few weeks ago, or is it time to offer something different?
I think that this could be a watershed event. I think that he signaled at that conference maybe that there was a crack between him and other policy makers on the committee there. That since then we've heard patience preached from others. I think he, signaled that he would be willing to take risk on inflation if need be in order to curtail downside risks to the economy. So I think this could be a moment analogous to kind of a mix of a 1987 or an Alan Greenspan 1998 Island of Prosperity speech, where he talks about things look really good, but sometimes, you need to act. Confidence is important. He alluded to that at the last meeting. And this could be, an important time, given that we have had things come in worse than expected this week.
Robert, what's the risk that if Fed Chair Jay Powell does indicate that he is ready to proactively cut rates, that long-end yields go up, that actually creates a liability for longer-term inflation expectations?
I think that's a reasonable question and a reasonable expectation. I mean, this yield curve is really flat. And in order to justify, a 3.90 10-year, you have to think they're going to cut 150 basis points, if this is going to be sustained. But I don't think that's their concern right here. I think their concern is confidence. And I think it's possible for him to preach the sound underpinnings of the economy, that imports are not a major aspect of the economy, that this is something that people will be able to get through, but he needs to be sure. And he needs to instill confidence in the economy, in the markets, in order to begin to throw a net, to let people know that they are there, that they have a dual mandate, and that they're prepared to look through the inflation, which he went so far as to say could be a transitory threat.
Robert, what's his incentive to do that, given the fact that this isn't a problem of their making and potentially they're solving, that the additional credit creation doesn't offset some of the uncertainty that you're seeing get injected into the financial system?
Yeah. I mean, I wasn't there, but this reminds me of 1929. Because in the middle of that huge decline of the stock market, about halfway down, that's when Smoot-Hawley was brought to the fore. And central bankers, are still looking back and regretting that there was not a more aggressive approach to heading off the Great Depression. So, Alan Greenspan in 1998, with that Island of Prosperity speech, the United States economy was doing great. Asia was in crisis, Russia was defaulting, and long-term capital management was freezing up, threatening the entire dealer community, and we're seeing some liquidity concerns in this market. There's a lot of arbitrage relationships in fixed income that hold together spreads, that keep mortgages issuable, and so on. And so I think he doesn't want to look back, 6, 12 months from now, whether things go great or whether they go terrible. Look back and say, we didn't do anything. I think he needs to show that they were willing to act. The whole economics community is up in arms about the tariffs being a destructive way to address this, rightly or wrongly, and the markets are very concerned. He needs to show that he's willing to step in, take some risk, to instill confidence that they will be there if they need to support this economy.
Robert, as you know, for you and the team, as a daily job, you've got to manage risk. No one can see into the future. I wonder how you've been managing that risk around fixed income and high-yield corporate credit at the moment after the spread widening we saw in yesterday's session. It's unusual. We don't typically see moves of 50 basis points plus in spread widening on high yield. That's what we saw in yesterday's session. What are you and the team doing?
Yeah, well, just to go right to the point of panic, and do you hit a panic button? I think this is a panic for cash, for people that are in cash, because this really opens up the prospects of cash yields dropping aggressively. I think it creates a panic for equity investors because they're clearly contingent on expectations for earning growth that may be, threatened by the rapid policy changes that are out there. But in fixed income, you're going to have some balance here between yield and spreads. So I think the Treasury equation, the yield equation has become less attractive. But the corporate market has a lot of sound underpinnings in terms of fundamentals. This is not 2008. This is not, WorldCom, Enron, thinly capitalized, high leverage situations, and a lot of high competition, spread out competitors and industries. There's been a lot of consolidation after COVID. There's been a lot of battening down the hatches from COVID through the war, through the hikes in interest rates. There are a lot of credits that are really well positioned to take this. So I think if you're seeing yields go up in a manner that offsets or more than offsets the decline in treasuries, this is a great spot for fixed income. So, do I think people need to be alert that this could go further? We could have a recession. That possibility is real. Yeah, but having growth drop from 2.5 to 0.5 or from 2.5 to 1.0 is not a nightmare for fixed income. I think after this initial panic phase, passes, think back to 2021. We're in the midst of an environment where nobody knew what was going to happen. There were huge flows into fixed income.
Yeah.
And that was very supportive of the credit markets. And there are a lot of credits that made it through COVID. So I think this is, something that may be very manageable for a lot of credits. There's going to be a lot of opportunity in this market. And for bonds, I think we're at a strategic buy point for the market as a whole in general.
Robert, just real quickly here, when was the last time you were this overweight corporate credit?
I can't remember the last time we were this low in our exposure to corporate credit. Spreads have been tight. We've been guardedly optimistic on the outlook for corporate credit. I think you are going to have positive excess returns. And I think that's especially the case from where we are now. So I don't think, this is something where we come into it and say, wow, we have way too much economic risk and, what are we going to do? I think this is an opportunity in the credit markets to find things that are going to be underpriced, that are going to do very well over the next 1, 2, 5 years.
Robert Tipp of PGIM. Hey, Rob. Good to catch up with you. As always, sir, thank you. On the outlook for corporate credit and fixed income right now, as we head towards the payrolls report 5 minutes away, the estimate in our survey, 140K. The price action looks like this. Equity futures down by 2.9% on the S&P 500. Stocks getting hammered. Crude is lower and down hard as this market focuses much more on the downside risk to growth than the upside risk to inflation, for the moment at least. And in the bond market, as we approach this jobs report, the 10-year yield is down by 14 basis points. The 2-year is down 17. We'll catch up with Stephanie Roth of Wolfe Research, Jeff Rosenberg of BlackRock, and Mohamed El-Erian. Jobs up next. The payrolls report is 20 seconds away and your scores look like this. Equity futures down across the board. On the S&P, we're down by 2.7. On the Nasdaq, we're down by 2.9. On the Russell, we're down by 3.7. And check out your bond market going into this report. Yields lower across the board, down 15 on twos. On a 10-year, down 14. A drop below 4%. A break earlier, below 450, 350 rather, on twos. With your jobs report, it's a wow number. Here's Mike McKee. Good morning, Mike.
Oh, boy, John, do we have a wow number. 228,000 after revised lower 117,000 the month before. Ordinarily, you'd say that offsets a lot. But given the situation now, this is going to have some repercussions for the Fed. Unemployment rises to 4.2% from 4.1%. And we see average hourly earnings up as forecast 0.3%, but on a year-over-year basis, we're getting 3.8%. Forecast was for 4%, and that was what we saw in February. So there's got to be some sort of base effect in there. Average weekly hours do rise to 34.2 as forecast. That's 0.1% higher than they were in February. Change in private payrolls is 209,000, up from 140 the month before. The revisions total, I mentioned the revision earlier, total of a negative 48,000. So you can, cross-reference that to what we got today, but it's still a very strong report. And finally, the average underemployment rate, 7.9%, the U6, that drops a little bit. But this certainly creates a bit of a conundrum. If you're thinking about the Fed, it tells you that might be a little bit harder to cut rates than people anticipated.
Mike McKee, thank you. I'll come back to you in just a second. If I showed you a chart of the S&P or just a chart of a 2-year yield right now, you'd have no idea that jobs report just came out. Equities are still lower on the session by 2.7% on the S&P. And if you turn to the bond market, the 2-year yield is still down by 14 basis points. Still lower by 13 basis points on 10s. Lisa, it's a monster upside surprise on the headline print. But there is a take on Wall Street right now that this jobs report, albeit a good one at the headline level, might be the last good one.
Which is why they expect the Fed to actually speak to the weakness. We just spoke with Robert Tipp of PGIM Fixed Income about how this is a Fed who wants to be seen doing something ahead of the weakness. This is not weakness that we're seeing. I just wonder, are we at a place where good news is bad news? Whether this ties the hands of the Federal Reserve that much more in the near term, just based on the fact that it is a massive upside surprise with wage growth still there and with an underemployment rate, that with a labor force participation rate that actually went up, not down. It makes it difficult for them to respond to weakness that might come.
So, Mike, to get you back in, that takes us to 11:25 when we hear from Chairman Powell. At 11:25, this is the data he's got. And the hard data isn't bad. The soft data is terrible. Prospects for the future, not great. But the hard data is decent. It's still OK. What does he say at 11:25?
I think he sort of echoes what Vice Chairman Jefferson said yesterday, that we have to see the totality of the data and how all of this is playing into the economy. I suppose it's true, as some of the analysts have said to you this morning, that if Trump suddenly looks at the markets and says, OK, I'll take the tariffs off, then all the danger goes away. But for right now, they don't have a meeting until May 7th. So there isn't much for the Fed to do except sit and watch. Couple of notes here in terms of the jobs, John. 3,600 federal jobs lost outside of Postal Service. So really nothing. That's half of what we saw in February. The big number this time is in retail sales, up 23, almost 24,000, including 20,000 at grocery stores. That reflects the end of a grocery store strike in Colorado that had 20,000 workers off the payroll. So it's not an actual increase in workers. So maybe we take that out of that headline number and it looks a little bit more realistic, but it would still put you above 200,000.
Mike McKee, thank you, sir. We'll come back to Mike a little bit later this hour. So we've got the jobs report coming in like this. Big upside surprise, 228. The estimate was 140. So that's the headline number. If you look at equities, recovering only slightly, still lower by 2.4% on the S&P. And in the bond market, yields down, not as hard as they were. We're down about 10 basis points at the front end of the curve now to 358. The next stop for this market is 11:25, around 11:30 Eastern time, when you hear from Chairman Powell, who has to confront the very real risk of upside risk to inflation and downside risk to growth. Stephanie Roth of Wolfe Research is with us around the table for more. Stephanie, good morning.
Good morning.
The last good one?
For sure, the last good one, and then it's going to take a big plummet lower.
At the same time, you have to wonder how much people can take this and see this as giving any sense of where we are coming from. Does this report indicate that we are coming from a position of great strength that will take a long time to really weaken?
I don't think it matters where we're coming from, to be honest. These tariffs are so big, they are going to be very damaging to the consumer. And by the way, businesses have no idea how to invest in this environment. So you're going to see a sudden shock. I would look at this as a shock to the economy as opposed to something that's more domestically driven, in which case then those things tend to take a long time to work their way through the data. So the fact that today's data was strong doesn't really matter a whole lot in the context of everything else going on.
At the same time, does it give you a signal of how much room the Fed has to act proactively the way that Robert Tipp was talking about versus not really doing anything just simply because the hard data, the totality of data, is showing that strength?
Yeah, I think either way, they're kind of in a position where they can't act unless the data were crumbling already, which hasn't been the case. So there was not a great reason to expect that would be the case for this print. They're going to have to wait until the data actually start to crack before they react. So they're in a really tough position. It's going to be really interesting to see how Powell spins this today. Because, yeah, he wanted to use the word transitory last time. I don't anticipate he's going to use that again. Base case is he'll probably try to talk about how they're ready to act. Of course, financial conditions have tightened a lot since we last heard from him, or at least from an equity perspective. they're going to have to wait until they see a notable rise in the unemployment rate until they can actually start to ease, because inflation is going to tick up notably higher on the back of all these tariffs.
Market's desperate for a circuit breaker right now, Lisa, as you know. It's either coming from Chairman Powell later this morning, or the president can pretend that she called again. And maybe that makes a difference, I don't know, going into next week.
This is a market that's gotten accustomed to having a circuit breaker, and often it has come in the form of Fed Chair Jay Powell. One thing that we keep discussing this morning, and I think it is the right point, is that this is not the Fed's problem to fix, and it's not the problem that they can fix. So how can they get ahead of this when they're facing what essentially looks like a stagflationary shock?
Joining us now is Jeff Rosenberg of BlackRock to weigh in on this jobs number. Jeff, first of all, we've asked this question all morning. It's worth asking again. How relevant is this number to you and the team this morning?
It's not particularly relevant, Jonathan. It's one of those, very unique situations where the data looking backwards is probably the least impactful to the forward-looking outlook. And you said it a few minutes ago when you talked about the market reaction. It's a big upside surprise. We came into this backward-looking. Economy is in pretty good shape. Labor markets in particular are in good shape. None of that really matters to financial markets right now. Financial markets are incredible discounting machines, and they're discounting the future story. And that's really about this tariff story, not really about the labor market.
So, Jeff, as you know, sentiment is already rock bottom. We've seen that repeatedly in surveys, and hard data based on this is still holding up. So how much longer can it hold up?
Yeah, well, there's a split in the hard data versus the soft data. The soft data survey data is much more about looking forward, and the hard data, is going to be about people taking actions. And I think you're going to start to see that show up in the hard data. And most importantly, for our economy, as much as the focus is on manufacturing, this is a service and consumption-based economy, and the most important issue for consumption is real wages. And so when you take something away from today's report that is important, it's that wage picture, and the wage picture has been pretty good. It's been holding up. Now it's a little bit of a concern in terms of the support that has had for inflation and the likelihood that we get back down to 2%. We're kind of more likely to stall out here at 3%. But you've thrown an entirely different wrench into the mix when it comes to the near-term inflation story, which is of course the tariffs and the impact that has in terms of growth. Away from the confidence shock is that this is a real wage killer in terms of short-term impact on inflation. And so that's going to be the way in which we see the hard data react. And I think, most importantly, the follow through in terms of the survey data is going to be one on the business side and investment. This is very, uncertainty is very bad for investment. I think you're going to see that. You're going to see that in the IP data. And then I think on the consumption side, to add the second to the 1-2 punch here is the real wage impact from what hopefully is a transitory impact on inflation, as Powell may repeat. Maybe he doesn't repeat it later today. But in the interim, it doesn't feel transitory. It's just what people are feeling in terms of the impact on real wages, and that is a drag in terms of hard data into consumption. And that's all kind of forward looking. So it's not yet there in the hard data that is a little bit more reflective of where we were.
Jeff, sit tight. I want to bring in Mohamed El-Erian of Queen's College, Cambridge. Mohamed joins us now. Mohamed, you've had a few minutes to go over these numbers. Your initial reaction, and then we can get to the much, much bigger picture going forward from here.
So while I agree generally that this is not as relevant as it normally is as an employment report, I do focus on the 0.3% monthly earnings growth. When people rush to predict lots of Fed cuts, they forget the difference between what is necessary and what is necessary and sufficient. Pronounced weakness in the economy is necessary for the sorts of cuts that are being priced in, but they're not sufficient. The Fed needs some sort of air cover on inflation. And most forecasts of inflation, as Jeff said, are now going to the 3 to 3.5% at the PCE core level. So this is quite a move. The 0.3 monthly earning growth that we saw in today's report is not consistent with air cover on inflation. So this is a report that suggests to the Fed, wait and see. And my hope is that Chair Powell this later this morning will do two things. He will walk back the notion that the tariffs' impact on inflation will be transitory, and let's eliminate that word again from his vocabulary. And the second thing I hope he walks back is the ease with which he dismissed the soft data. Because as Stephanie said, expect the hard data to weaken in the months ahead.
Mohamed, are we dismissing the strength of this labor market report at our own peril? The idea that corporate America has thrived despite what the U.S. government has occasionally done, and that there is quite a bit of robustness and people who are employed and able to absorb a greater amount of price increases that might get passed along to them.
I think, Lisa, what this reminds you is that the structure of the economy is fine. And this is important because while there is general agreement on a very bumpy few months, there's significant disagreement on where this would lead to. There are those who think that the pain is worth the gain that's coming forward. It's just a matter of time, and the structure of the economy is strong enough to take us through this very bumpy journey. And there are others that worry that the structure of the economy is not as strong as we think it is. This number here gives you some confidence that the economy is fine if we can just avoid repeated self-inflicted wounds.
If you are just joining us, welcome to the programme. Moments ago, a big upside surprise on the payrolls report, 228, the estimate 140. And we look at the charts. In the immediate aftermath of that jobs number, this market hardly blinked. Yields are still down 15 basis points at the front end of the curve, 352. And in the equity market at the moment, equity futures are lower by 2.8%. Mohamed was looking forward to Chairman Powell at 11:25. And Stephanie Roth, he talked about that word transitory, the T word. Does that get canned today?
I would imagine he won't use it again. I guess, of course, we'll see. But I think we'll have to be a little bit more cautious about this. And I think it's also important to think about the fact that transitory doesn't mean the same for every person, which is the problem. And the extent of the tariffs are so big that it might take a really long time for this inflation shock to work its way through the economy. So yes, it is.
The T word, as you know, speaks to the same mistake we all remember, which was waiting too long. That's the problem with the T word at the moment. Waiting too long to do something about inflation. This time around, I wonder, conditioned by their previous experience, do they wait too long to do something about growth and downside risk to growth? Because that's the major risk for this market.
Yeah, I think that's potentially the case, and they're going to have to wait and see. And by the way, they're going to be watching inflation expectations. They've anchored, especially the last time in 2018, they said inflation expectations were the main anchor to determine whether they can look through it or whether they have to act more hawkishly as a result. And if inflation expectations start to pick up, they're gonna be in a tough situation for a little while. They're gonna have to wait until things get really bad before they can act. And by the way, inflation expectations, long-term ones, are largely driven by your most recent experience with inflation. Well, in 2018, we had no inflation in the past prior years. This time it's very different. And inflation expectations are likely to pick up a lot more given experience with inflation and the fact that these tariffs are just so large.
Which raises the question, Jeff, and I would love your thoughts on this, how the bond market responds to either a dovish message from Fed Chair Jay Powell or a hawkish message. If he does put transitory back in the bottle, does that give you more confidence, frankly, to go into long-term bonds? Because eventually they might have to cut rates a whole lot more.
Yeah, it's really interesting if you look at the last 2 days and what has transpired in terms of the bond market. So yesterday, you saw a big rally in rates, but it was mostly led by the intermediate and short end. If you look at the 30-year portion of the curve, it lagged. For a brief moment in time, it barely budged at all. Contrast that to today. And today what you're seeing is a very different picture from the bond market. And probably the most striking is that you're seeing not only longer term inflation expectations fall, but even some of the shorter term inflation measures. And so Stephanie was just talking about it. It'll be challenging for the Fed because it depends on how you're measuring inflation expectations. Everybody's seen the Michigan survey. The survey measures will likely be going higher in an environment where people are seeing higher prices due to tariffs. Potentially that gets a little bit offset by what we're seeing in oil, but the impact in terms of survey responses may be to higher inflation. Meanwhile, in the bond market, they're really looking at the financial conditions tightening that's going on, seeing the implications for consumption. 70% of the economy is driven by that side, and that's quite negative and starting to price in today much more of a deflationary environment. So you're seeing the back end of the curve fall, you're seeing break evens fall, and you're even seeing short end inflation measures, which have really been this story about stagflation. When you measure the stagflation, it's short measures. Inflation in the near term is expected to go up. Now some of that stuff is starting to get rolled over. So it's possible here the bond market may try to lead the Fed to this message of transitory by basically cutting the interest rates both in real and nominal terms for them.
I can tell you this market move's not leading the president to changing his mind. Just posted on Truth Social right now saying that my policies will never change. If you're looking for someone to blink this morning, it's not the president at the moment.
He says to the many investors coming into the United States and investing massive amounts of money, my policies will never change. This is a great time to get rich, richer than ever before, which raises this question of how much the bond market and the stock market matter to him at a time where there is real concern on Wall Street that isn't being reflected in his commentary.
Jeff mentioned crude. Crude is down by 7.5% on WTI. Brent is down by close to 7 full percentage points. Mohamed, quite clearly, this is a shock to the cycle. Quite clearly, we're repricing growth lower. From your perspective, how much of a shock to the system is it, and how long does it take to internalize major regime changes like the one we might see?
So, John, we are repricing growth outlook in a significant manner. Interestingly, the beta for the rest of the world is catching up. It started out being a US phenomenon. Now it's spreading. People are realizing that if the US growth rate falls by X, it may fall then by more than X outside the US. And I think that is correct. The beta is greater than 1 outside the US. So it's a major revisiting of the growth outlook. How long? It depends on what other countries decide right now. The president's message will encourage other countries to retaliate. You see, there's a choice out there between retaliate, de-escalate, or just wait. And we all want de-escalation, but the escalation requires both sides to play along and for there to be an amount of trust that this is not a multi-round where you're going to have to renegotiate every time. If you de-escalate now, it will hold. That isn't there right now. So I suspect you will see more countries move towards what China did, which is a response that involves both tariffs and non-tariffs. And where that comes in for the bond market is we're now going to start talking not just about interest rate risk, but credit risk in the bond market. Credit risk has been, until very recently, really well protected. But now we're starting to see it come under pressure. And credit investors no longer have the shield of all-in yield because both components now are in play. So the next thing to look in the bond market, John, is going to be not just at government bonds, but look at credit, and in particular high yield, because that is significantly vulnerable right now.
Yeah, we saw yesterday the biggest spread widening going back to the heart of the pandemic in some of those riskier instruments. We caught up with you earlier this week, Mohamed, and you said that it's about a 50-50 chance, in your estimation, that we either have some sort of Reagan and Thatcher-esque reordering of the global trade system, or you go back to the 70s, you go back to Carter on steroids. Do you still think it's 50-50?
I do. What has changed, if you remember, I said my own perception is 50-50. The market is at 80-20. The market is absolutely convinced this is a Reagan-Thatcher moment. I think that 80 has come down in the last couple of days, and for good reasons. So, yes, I'm still at a 50-50 because there is the upside of significant innovations in tech that are there that are multi-year beneficial to productivity. So, yes, I'm still 50-50. The market is repricing now closer to 50-50, which is, I think, that's the correct thing for the markets to do.
We can add to that. I think there's a lot of faith at the moment, based on the conversations we've had so far this morning, Lisa, that many people still don't believe these tariffs even go on. And if they do, it won't last long. We've got these two key dates now. April 5th is tomorrow. So that's the baseline 10% tariff. April 9th is when you hear the 20 on the EU, 24 on Japan, 34 on China, and the big numbers on everybody else. Everybody thinks that we can negotiate something in between. I think they're scared at the moment that we won't. But if you go through all the research on Wall Street right now, the base case is this won't happen. And I wonder where that faith comes from.
At a certain point, there was this belief heading into this year that the Fed put was there and that the Trump put was there. To imagine that an administration would allow an economy to tank or a market to tank seems infeasible. And I think that's what a lot of people are looking at. If you put on top of that this question of where is the off-ramp for the tit-for-tat retaliation, how do we start to estimate the damage from that? It becomes a fool's errand to try to model out. And I think a lot of people are just saying, look, we're just going to assume that's not going to happen.
Jeff, where does that faith come from in the market right now, that it's so bad it just won't happen?
I think, as you're pointing out, that faith, or as Mohamed was pointing out, I think that faith is being challenged day by day, and I think that's why you're seeing the market reactions. So I think the only path forward is to observe what this administration and the policies that it chooses to implement are. It's very impossible to forecast, but the 80-20 to 50-50 I think is right, and you see it in these market reactions.
Stephanie, how do you model this?
So we've definitely tried to model this a number of different ways. Base case is we've done the fool's errand approach and tried to model from a global perspective. What happens if we apply all of the tariffs? What happens if everybody else retaliates in kind, and then you get some offsetting factors? The numbers are kind of comically bad. You're looking at something like a 2 to 3 percentage point headwind on GDP if this all really plays out. Again, we don't think it will play out to that extent. We think it will be pretty severe, which is why we took our growth estimates down for this year to 0.5% and recession odds up to 40%. Because these policies are bad, and it's hard for the administration to walk away from it unless something forces them to do so. And we're not there yet.
Stephanie Roth of Wolfe Research, a special thanks alongside Jeff Rosenberg of BlackRock. Mohamed, I just wanted to give you the final word before we go. What you'll be looking for going into the weekend and as we reset going into next week, what's the number one thing at the top of your list?
Number one is listen to the administration. I think there is a belief that you may have to break some things to remake the global order, but remaking the global order is the objective. And you have the very specific example of X, where you had to break things to remake it at the back of people's mind. But also listen to business. And I've been on the phone nonstop with business leaders, and they are not waiting, John. They see a hit on the cost side. They're worried about demand destruction on the revenue side. And they're starting to make difficult decisions about the balance between profit margin compression, higher prices, and cutting costs. And these discussions, believe me, are really active. Business is not going to wait because they're going to try to rebuild resilience, because whatever people disagree on, I think most of us agree on this being a very uncertain environment.
Mohamed, appreciate your time, sir, as always. Mohamed El-Erian there of Queen's College, Cambridge. That last point on what companies are going to do through the next few weeks, few months, that speaks to why so many people on Wall Street believe that jobs report from 24 minutes ago, the last good one. Because when you start to put pressure on margins, when companies have to start thinking about pulling the lever on costs, that's when the labour market comes into it.
And that's the reason why people are looking at indicators like what we saw yesterday from ISM Services, the employment component, as you mentioned, going into contraction, going into some of the lowest levels that we've seen on that index going back to late 2023, but also the most since 2020. It is a difficult scenario to try to model out at a time of a shock due to policy, given that the economy was strong heading into it.
And this was always going to be a long week, wasn't it? Do you want to do a special programme Sunday?
What are you doing? Seriously, this is what you're doing?
Just seeing if you're keen, seeing if you might be interested.
Depends.
I mean, tariffs go on.
The truth is, no one's going to be working. No one's going to be resting. I mean, everyone is going to be working and focused on what happens over the weekend, because this is a seismic shift. So sure, if I'm game, if you're game.
You know, at the start of the week, I said, if you wrote a book in 10 years about this week, would it get its own chapter? I think after the week we've had, if this policy is enacted, this will be the book. Build the library. This could be a major change for the global economy.
The entire book could be what actually went into creating that model that President Trump put out there.
That gets its own chapter.
That gets its own 5 chapters. I mean, exactly how it was modeled and the reaction in the market. Right now, it really remains to be seen where the off-ramp actually is.
Equities down 2.5% at 9:15 Eastern Time. Just a programming note. We'll catch up with the White House and get their reaction to the jobs report. We'll speak with the US Labour Secretary, Lori Chavez de Rima, so look out for that. Then on Monday, here's your lineup. Chris Verona-Strategas, the former senior Trump trade advisor, Kellyanne Shaw, Liz Ann Saunders of Charles Schwab, and Michael Gaper of Morgan Stanley from New York City. Try and enjoy your weekend. From New York City, this was Bloomberg Surveillance.